Here comes the chat. Chat. It's been a while, chat. It's been about a week since we last streamed, I think. Pretty close to a week. So we'll see if anyone shows up. The stream's been pretty dead lately. That's why I don't put any effort into it anymore. Nobody wants to watch, it seems. So it seems. And if nobody wants to watch, why should I come live, you know? You know, I do love it, but what makes it fun is the people who actually show up. Me just reading articles and stuff isn't that exciting. To me, at least. Only sometimes. Let's see. Got a Motley Fool article. It's probably the bot article that we've read a million times. Oh, this looks, I don't even know if I want to keep making these article stream clips, though. That Berkshire one crushed. It's like the GameStop ones don't even get views. Nah, I don't like that article. This one. It's not interesting. Where's the chat, bro? There's nobody coming, I don't think. I don't think anyone's coming to the stream. Is what it is. Is what it is. Oh well, we had some good times. We had some good times on the stream. That article. Oh wait, that's the Motley Fool one. That one could be okay. Yeah, I forgot about that article. That one should be good. Oh yeah, there's a Seeking Alpha article too, I forgot. There's actually a lot of articles. But honestly, what's the point? What is the point? A contributor to GameStop's long-forgotten Steam competitor. Wait, who's that? Larry Koopman, big project. It was to be GameStop's answer to Steam. Wait, is this like an actual interview? there a video of this interview? How's there one person here, bro? Larry Cooperman, a newly retired, best known for his retro, was part of the team. Cooperman says the whole idea of third-party digital distribution didn't seem intuitive. Is there a... I'll look this guy up. What's his name? Gabe Cooperman or something? Gabe Newell. Wait, is that right? Larry Cooperman. Okay, Larry Cooperman. Let's see. Wait, was that the video? I think I saw it. Is this it?
Howdy folks, I'm Curtin Davina. This is Jean-Luc Psyche. Hello. Their intent.
It starts becoming not unrecognizable, but before it starts taking on some like night dive kind of aesthetics and tones.
There's always a challenge when you're working on IP that's beloved not only by the larger audience, but within the studio itself. I mean, there's always the challenge.
Intent and scope of it is much smaller.
And that way of handling the interface back to the remake. And so in that way, a lot of people regard the, but you'll see tone. And a lot of game developers.
Is that even the... I don't even know if that's the right interview. I don't know. I don't even think I'm going to waste my time reading this stuff anymore. If nobody's going to show up for the stream, why should I waste my time doing this? Straight up, for $1. Yippee. I make a whole $1 reading all this stuff to you guys. Yippee. Wow. Probably just stop wasting my time doing this. Should probably do earnings calls only at this point. Have one of most... It's just, I don't understand streaming, bro. I don't understand streaming. I have my most viral video I've posted in a long time. Supposedly I have all these like followers and supporters of my stream, yet I take a couple day break and everyone, or I don't know. It's a waste of my time streaming. I love streaming, but it's a waste of my time. It's pretty sad. Pretty sad all the time and effort I've put into this for nothing, literally. So, if that's how it's gonna be, I'll just stop streaming straight up. I'll come back when I guess I'll just chill here a little bit, but I'm not gonna post GameStop articles and stuff, like if that's really how it's gonna be. I'm not gonna waste my fucking time, bro. Like, literally nobody's here. It's fucking stupid, bro. Pretty stupid. Alright, that's nothing. This is a pretty good article. That one looks pretty good too. Yeah, I'll do earning streams, but I'm not wasting my time with this anymore, bro. Like, really, nobody's gonna show up? Okay. Okay. That's fine. That article could be decent. Wait, this is just that one article we've read before. Is it not? No, there was an update. What got updated? It's that same article, but it says it got updated. I swear this is the same article we already read. Transformation outcomes deployment. Price target 220, current price 23. Date April 2nd, 2026. Yeah, I don't know. That goes to that. That's not a good article, I don't think. Responding to a viewer question on his podcast by the company Eisman stated unequivocally that betting on retailer to buy profitable business is a pipe dream. Oh, that's where you find that. He has a podcast? Wait. Steve Eisman podcast. Is it on YouTube? Let's see what this guy's got. When was this posted? April 7th? Oh, that's not when it was first posted. So it's gotta be this.
You want to file free? Hit it.
And there There should be a transcript. Nothing. So it's not in that. Okay. What video is it then? I guess it could be this one. What? It said on his podcast, did it not? Viewer question on his podcast. Wouldn't it be nice if they told you what video it was? I think this is just about the war, so it's probably not on here. Nope. Man, this is such a good stream. There's so many people here. So much action. Like, what the fuck, bro? It doesn't... Where can I find this dude's video, dude? Oh, it's right here. Private credit creators. Did I not look at that one? I swear I looked at this. Did I not? Oh, it's right here. How come how come it didn't work when I searched it in the transcript? That doesn't make any sense. Maybe the little search bar doesn't work? Yeah, I guess this little search bar doesn't work, which... What's the point of that? What is the actual point of that? Oh, I shouldn't even waste my time making these videos anymore, but whatever. Should probably just quit YouTube. But we'll see what this idiot has to say, and we'll go for a little longer, a couple more months. Nothing changes. I'm done, bro. I'll just get rich off GameStop, and we can all go our separate ways. That's fine by me. If that's how it's gonna be, that's fine with me, bro. All right, Steve Eisman got a question on his podcast about GameStop, so let's see what he's got to say about it.
To address two questions from viewers. First question is from Cormac, who says, "Hi, Steve. Massive fan of the show and the way that you conduct interviews, breaking down extremely complex information into something that even someone from a non-finance background can digest. I, however, have probably one of the dumbest questions you will receive.
One of the dumbest questions, asking about GameStop, the most undervalued, fair value, profitable business. On the stock market? Not a very dumb question.
Is GameStop, symbol GME, at its current price, which is around 22, a value stock? I am not one of the people that would invest looking for short squeezes or other nonsense, but in this current environment where private credit is threatening the US economy, I see a stock with a massive stockpile of cash and wonder if it would be worth investing in.
Why do people ask random people on the internet what they should invest in? Like, do you really need Steve Eisman's fucking opinion to make an investment? Are you that brain dead? Like, come on, dude. There's no way Steve Eisman is any smarter than literally anyone. Nobody knows what they're talking about when it comes to the stock market. Nobody knows anything. They just guess, and most people don't even bet on what they're talking about. So it's like, I don't know. Is Steve Eisman going to short GameStop? You know, he's going to sit and bash on it probably, but is he actually going to short it? Probably not. So his opinion's completely irrelevant. If you're just going to sit and bash on something or talk about something and not bet on it, your opinion is irrelevant.
I know that Michael Burry has mentioned that he sees some value in the stock, particularly if they use their cash to acquire other businesses with more upside in revenue. Thanks again for doing this show and being open to receiving questions.
That's funny because the acquisition was never even in my original thesis for the stock or for the business. So, like, that's the reason why people are interested in it now. That's pretty weird. Pretty weird. I think that's just a bonus.
My response: without question, this is not a dumb question at all. Let's review a little history. GameStop operates a declining business. It sells video games.
No, it doesn't. It used to operate a declining business, but not anymore. This dude is behind on his research, apparently. He has no clue what he's talking about.
Games in retail stores, but the entire business has moved online. In 2021, GME was a heavily shorted stock, but then became a meme stock. Leaders of Reddit boards told their followers to engineer a short squeeze by buying GME, and the stock soared multiple times and wiped out the hedge funds who were short. Literally wiped them out.
I still think that's very debatable, but that's fine. I think the shorts started to close as Ryan Cohen joined the board. He joined the board before the squeeze, I'm pretty sure, if I'm not mistaken. Or maybe he took his position before the squeeze. I don't exactly remember, but there's probably more reasons than just that why the stock squoze. Maybe that's a reason, but I don't know if I'm fully convinced.
That's the danger of being involved in a heavily shorted stock. Believe me, I know. You can be right on the fundamentals and still lose money. Top line fundamentals at GameStop have not gotten better, but the company has cut costs and so is profitable. Also, the company was very smart and used the price surge to raise capital. Currently, GME has $6.3 billion in cash and cash equivalents, but $4.1 billion in long-term debt, so it has net cash of $2.2 billion.
No, it doesn't, because the long-term debt is from convertible bonds at 0% interest. So sure, you know, technically, I guess they do have less cash than what they're holding. This must be old too. Did he say 6 billion? They're sitting on like 10 billion cash, but so, you know, you're sitting on 4.2 billion of 0% debt that you can pay back with shares. You don't even have to pay it back with the cash. I don't think this guy knows what he's talking about.
Market cap is $10 billion. In a recent Substack, Michael Burry argued that GME has value because they could use their cash to acquire other businesses. I do not find this argument compelling at all. It sounds like a pipe dream to me. Buy a stock because they could buy something worthwhile at a good price? Good luck with that.
That's not why you buy GameStop. You buy GameStop because it's one of the only fairly valued stocks in the market with a profitable business behind it, and a pretty fast-growing profitable business when you're comparing it to the market cap of the stock. So, no, sure, you know, I kind of agree that you don't buy it for the acquisition, but to say it's not important is pretty crazy.
Maybe they buy something good, and maybe they buy something not so good. Maybe they buy something at a good price, and maybe not. Too many maybes for me. Second question is from Mal.
Too many maybes for me. Yeah, well, there's no maybes for me. Whenever I have money, I just buy the stock. I don't even care. There's definitely no maybes.
who says, "Hi, Steve. Thank you for the great cover."
I think that's all there was on GameStop, so whatever. Well, at least I didn't have to read about it then. Oh, these are different. Wait, that's a Steve Eisman one. So we don't need anything about him. Because we got that clip. Oh, yeah. 3 people. What? 3 people here in a dead chat? This is pretty sick, dude. Like, what the fuck, bro? I was hoping people would actually come here so they could verify this. But, whatever. I'll just stop streaming about shit, bro. I'll just stream earnings calls and that's it. This is crazy, bro. Pretty annoying. Pretty annoying. Like I said, I'll go for a little longer, maybe like another month or 2, but if nothing changes, I'm done, bro. This is a joke. Been putting in more effort than I've ever have on this YouTube channel, and it's getting worse. I have less viewers. Like, nobody chats in the chat. Like, it's a fucking joke, man. It's literally a joke. And I'm not gonna waste my time if that's how it's gonna be. I'm also making less money than I've ever made. The only reason I'm gonna make money this month is because of that Berkshire video. It's just a joke. YouTube's an all-around joke. Being a streamer seems like a joke. It's like, how I just don't get it, bro. How do you have how do you create like a real following of people who actually care about the stream? It's just not even a thing, bro. Doesn't even seem real. How do people have like thousands of followers that watch them all the time? And I can't even, people who watch me, have been watching me for a year, don't even pull up anymore. It's like, it's just a joke, man. It's actually a joke. Keep your chin up. I mean, it'll be fine. I mean, I'm gonna get rich from GameStop either way, so it doesn't even matter. It would just be nice to share it with the people that have been following me. But nobody cares about this stream, so, you know, we're not even gonna be able to do that, probably. Fine by me, though. Let's read a couple more articles, I guess. GameStop thought buying games online was a passing phase, says former business developer. In a GDC talk, Impulse creator Larry Cooperman explained how the retail chain bet the farm on brick and mortar. According to former alright, I'll restart here. GameStop thought buying games online was a passing phase, says former business developer. According to a former Stardock business developer Larry Cooperman, retail chain GameStop was once convinced the digital distribution of video games was merely a passing phase, and that once the fad was over, brick-and-mortar stores would continue their dominance in the industry. This would be the same GameStop that right now is selling your secondhand Funko Pops, price gouging on Pokemon cards, and writing memes as it closes down hundreds of stores. Pretty much anything but selling video games. It's definitely not the same management team, though, so I don't know. It's kind of weird. As reported by PC Gamer, one of the creators of GameStop's one-time digital store, Impulse, gave a talk at GDC this year that reflected on this extremely misguided portion of GameStop's history. Larry Cooperman was a business developer at a software company turned games developer, Stardock, where he helped create Drengen, a web store for games that would go on to be rebranded as Impulse. The latter was launched in June 2008 in response to the sudden rise of Valve's Steam, and for a while looked like it could be a competitor. It was bought in 2011 by GameStop, where Cooperman reports it was just not taken seriously, with the company convinced his physical store was where the future lay. It's hard to remember now that in 2008, Steam, while still significant, was much less of a big deal. 2006 had seen the storefront start to grow, where previously it had mostly been used for keeping Valve's games up to date, as well as selling a handful of games Valve wanted to support. But it wasn't until 2007, the release of games like BioShock and Team Fortress 2, that people really started to take notice. Even so, by 2008, it was still nowhere close to replacing the notion of physical copies of games. Stardock, the creators of Galactic Civilization and Sins of Solar Empire, was also a very established software company, and swiftly responded with Impulse, a direct rival that was mostly selling the same games as Steam. There was a very brief time where gaming sites were listing the two of equal primary choices for PC games. Impulsive decisions. As such, all the major publishers got on board with the Impulse, making it a very interesting prospect for a game retailer to buy. By 2011, GameStop made that purchase, and as a result employed Cooperman to keep working on it for a couple more years. This should be a point at which we say, and that's how GameStop ensured it was future-proofed at a point where brick-and-mortar stores began to lose ground, preparing itself to become the main rival of Valve's Steam. Except that's not what happened at all. According to Cooperman, when the retailer gave him the role of head of electronic distribution, I thought that was going to be my job forever. Now retiring, Cooperman told the story at this year's GDC, where he explained, I guess back in that time, it was completely different management than it is at GameStop now, but GameStop thought that electronic distribution was just a passing phase, and brick and mortar was going to come back strong. He parried this, PC Gamer says, as I've seen in the future, it looks just like the 1950s. By April 2014, GameStop had completely run Impulse into the ground and closed down the whole online store, and it hasn't been possible to access games bought via the site for over 7 years. But how that whole brick-and-mortar prediction worked out, GameStop has closed over 1,300 stores since 2024, with 727 of with 727 of them God damn it. With 727 of them going in 2025 and hundreds more in January this year. Okay. That was a terrible stream clip. But whatever. Well, this is pretty dumb, bro. $12:30. I'm about to end the stream, I think. I don't even know if I want to do this anymore, bro. Straight up. Like, this is a joke. What's up, AA Ron? How you doing, bro? God, it just seems like such a fucking waste of time, bro. I don't know, man. Just seems like a waste of time. Stay positive. That's I'll try. I'll try, my friend. Alright, whatever. I guess I'll just keep reading. GameStop short squeeze, a market structure case study. In January 2021, GameStop surged from under $20 to nearly $500 within weeks, triggering billions in losses for hedge funds and forcing trading restrictions across major platforms. What initially appeared to be a retail-driven rally quickly evolved into a real-world stress test of modern financial market structure, exposing how liquidity, clearing systems, and investors' behavior can interact under extreme conditions. Key takeaways: market structure can amplify volatility during periods of stress. Clearing and settlement systems are critical to maintaining market stability. Liquidity constraints can affect both brokers and traders. Behavioral forces can drive prices far beyond fundamental value. Effective risk management must account for both structural and psychological risks. Understanding the build-up. Excessive short interest and crowded positioning. Prior to the squeeze, GameStop exhibited exceptionally high short interest, exceeding 100% of its publicly available float. This reflected a heavily crowded trade, where multiple institutional investors held similar bearish positions. Hedge funds, including Melvin Capital, viewed GameStop as a structurally declining business due to the rise of digital distribution. However, this consensus positioning created systemic vulnerability. Any upward price movement could force rapid unwinding. Retail participation in options activity. Retail investors, many from r/Wall Street Bets, identified this imbalance and began aggressively purchasing shares and call options. This introduced two important dynamics: direct buying pressure on the stock, indirect pressure via options hedging by market makers. These forces combined to create the condition for rapid, self-reinforcing price escalation. The mechanics behind the price surge. Short squeeze. As GameStop's price began to rise, short sellers were forced to buy back shares to limit losses. This additional demand pushed prices higher, triggering further short covering. Gamma squeeze. At the same time, market makers who sold call options hedged their exposure by purchasing the underlying stock. As prices rose, hedging activity intensified, adding further upward momentum. Together, these mechanisms created a powerful feedback loop that drove the stock's rapid ascent. The GameStop episode is best understood as a breakdown in how different components of the financial system interact under pressure. Clearinghouses and collateral dynamics. Organizations such as the Depository Trust and Clearing Corporation are responsible for ensuring that trades settle even if one party defaults. During periods of extreme volatility, clearinghouses increase collateral requirements to manage risk exposure. In the case of GameStop, these requirements rose sharply due to elevated price volatility, concentrated trading activity, increased counterparty risk. Importantly, clearinghouses do not anticipate risk, they respond to it. This reactive framework can create sudden liquidity demands across the system. Broker constraints and trading restrictions. Retail brokers such as Robinhood were required to meet these heightened collateral requirements. To manage this pressure, some brokers restricted the purchase of GameStop shares. While controversial, these actions were largely driven by limited immediate access to capital, the need to comply with the clearinghouse requirements, risk management obligations to maintain operational stability. This highlighted the dependency of the retail trading platforms on broader market infrastructure. Liquidity breakdown and execution risk. As volatility surged, market liquidity deteriorated significantly. Retail brokers facilitate clients' trades, face liquidity constraints and restricted buying. Clearinghouses ensure trade settlement, raise collateral requirements rapidly. Market makers provide continuous liquidity, increased hedging activity amplifying demand. Hedge funds execute directional strategies, forced to unwind short positions under pressure. Retail traders participate in markets. Coordinated buying intensified volatility. This environment led to wider bid-ask spreads, execution delays, and increased price dislocations. Risk management failures across participants. The severity of GameStop event was amplified by weakness in risk management at multiple levels, institutional risk failures. Hedge funds underestimated the dangers of crowded trades, the speed of sentiment-driven price movements, the asymmetric risk of short positions. The experience of Melvin Capital demonstrated how quickly losses can escalate when positioning becomes one-sided. Retail risk exposure. Retail participants also face significant challenges. Entering positions at elevated price levels, limited understanding of volatility and liquidity risks, absence of disciplined exit strategies. That's a huge one. While early participants benefited, many late entrants incurred substantial losses during the subsequent decline. The psychology of the surge. The GameStop phenomenon was not purely structural, it was also deeply psychological. Key behavioral drivers, fear of missing out, FOMO, rapid price increases attracted new participants, herd behavior, investment decisions were influenced by collective sentiment, narrative investing, the retail versus institutional storyline amplified engagement. These behavioral forces contributed to price movements that diverged significantly from underlying fundamentals. The rise of meme stocks. The GameStop episode highlighted the emergence of meme stocks, companies whose trading activity is driven largely by social media and online communities rather than fundamentals. Wouldn't that be like every stock? Platforms like r/Wall Street Bets amplified retail participation, creating rapid, sentiment-driven price surges. From a market structure perspective, meme stocks constrain liquidity, increase volatility, and amplify hedging flows as brokers and market makers adjust to sudden surges in demand. This phenomenon illustrates a shift in modern markets. Investor attention and collective behavior can now significantly influence price movements alongside traditional fundamental factors. Why this still matters in today's market. Although the GameStop episode occurred in 2021, its implications remain highly relevant in today's market environment. Ongoing structural themes. Retail participation remains elevated across global markets. Options trading volumes continue to influence price dynamics. Regulatory scrutiny of brokers and market practices has increased. Digital platforms enable faster distribution of information and misinformation. Even in 2026, similar conditions can emerge in assets with high short interest, concentrated positioning, strong narrative-driven momentum. Risk management recommendations. For modern investors, the GameStop episode offers several actionable insights. Avoid excessive exposure to crowded trades. Monitor positioning indicators such as short interest. Assess liquidity conditions before entering volatile assets. Apply disciplined position sizing to manage downside risk. Establish clear entry and exit strategies in advance. The GameStop episode demonstrated that market risk is no longer driven solely by fundamentals or macroeconomic factors. Structural dynamics and behavioral forces can dominate price action, particularly in digitally connected markets where information spreads rapidly and participation barriers are low. Frequently asked questions. What caused the GameStop short squeeze? The squeeze was driven by a combination of excessive short interest, aggressive retail buying, and options-related hedging by market makers. These forces created a feedback loop that rapidly pushed prices higher. Why did brokers restrict trading? Brokers faced sharply increased collateral requirements from clearinghouses, which required immediate capital. To manage liquidity risk and meet regulatory obligations, some platforms temporarily restricted buying activity. What role did clearinghouses play in the event? Clearinghouses ensured that trades could settle despite extreme volatility By increasing collateral requirements, they reduced systemic risk, but also contributed to liquidity pressure on brokers. What is a gamma squeeze? A gamma squeeze occurs when market makers hedge call options to exposure by buying the underlying stock. As prices rise, additional hedging increases demand, accelerating upward price movement. Can similar events happen again? Yes, similar conditions can arise in assets with high short interest and strong retail participation. While regulatory changes may mitigate some risks, structural and behavioral dynamics remain present in modern markets. I mean, it definitely could happen again, but I think GameStop was a very unique thing because people thought it was going to go bankrupt, or, you know, institutions shorting it thought it was going to go bankrupt, and then it didn't. So I think I don't know. A lot of companies that are potentially going to go bankrupt probably won't have the same turnaround. Summary: the GameStop short squeeze was not merely a speculative anomaly, it was a structural stress test that revealed how modern financial systems behave under pressure. As markets continue to evolve, understanding these underlying structures is essential. It demonstrated that liquidity, clearing mechanisms, and investor psychology can collectively drive extreme market outcomes. Disclaimer: this material... Okay, we don't need a disclaimer. We don't need a disclaimer. Pretty sure that article is AI. Pretty sure. We've almost been streaming for an hour and we've had 5 chats in the chat. Yeah. Pretty cool. Pretty fucking sick, dude. Pretty sick. And 4 of them is one person. Yep. I don't know. This will likely be my last month on YouTube. I don't know, man. If I keep going, I'll be very surprised. We'll see. We'll see. GameStop is fairly valued, and it's now focused on M&A. GameStop is fairly valued at current levels, with a 1-year target price of $23.14, which is flat compared to its current share price. GME's $9 billion cash and securities position enables potential large-scale acquisitions, with management explicitly signaling an M&A-focused strategy. Store closures are complete for 2026, supporting flat revenue projections and continued margin improvements from efficiency gains and collectible sales. Significant uncertainty surrounds GME's acquisition plans, regulatory risks, and potential shareholder pushback, warranting a hold rating until strategic clarity emerges. I still think GameStop may achieve a successful turnaround. My original thesis was that GameStop was a turnaround stock because it started selling higher margin collectibles. I said that its pivot was working, but I still considered it a hold because it appeared slightly overvalued. But now, investors are interested in GameStop for another reason. GameStop has a lot of cash on its balance sheet, and now plans to use its cash to buy another company. If that happens, investors could be looking at a very different company. So in this update, I decided to investigate what would happen if GameStop did make a big acquisition. For the time being, though, GameStop's valuation appears reasonable for its current gaming store business. GameStop closed or sold 998 stores in 2025, According to its 2025 10K, and it now has 2,206 stores, so both its revenue and its expenses are lower now. In Q4 2025, GameStop's revenue fell 10.8% to $1.104 billion, but its gross profit rose 6.4% to $386.8 million. So the retail store's margins are still improving. If you adjust for other factors such as fluctuations in Bitcoin prices and tax benefits, it looks like GameStop's pivot to collectible sales is still working fairly well. GameStop didn't report Q4 comps or provide 2026 guidance, though, which is unusual for a retail store, but again, its investors might not care about that. I definitely don't. I don't think guidance is important at all. The less the market knows about the future of GameStop, the more people will have their little hold ratings and their speculation on whether it's going to work out or not. Should just keep the price lower the less they say. The most important thing in GameStop's report is that the company has $6.3 billion in cash and $2.71 billion in marketable securities, so it effectively has $9.01 billion in cash right now, and that might allow it to buy a much larger company. So that's the first factor I'd consider in this update. They also have that $700 million that's like hidden, or it's in a different account. I don't know if the $9 billion factors that in. I don't think it does. GameStop might be able to buy a larger company than investors expect. GameStop also has $4.16 billion in long-term debt, so it has a net cash position of $4.85 billion. That's not how that works. Just because GameStop has $4 billion in debt, it's convertible bonds, so they can issue shares to the bondholders. They don't have to use cash. So to try to say that GameStop has less cash because they're sitting on this debt, that is completely inaccurate. Especially, you have to know what kind of debt they're sitting on. You can't just be like, so it has a net cash position of $4.85 billion because they got $4 billion in debt. No, that's not how that works. And it might be able to spend even more than that on an acquisition. I've seen other companies leverage themselves up to 4x net debt to EBITDA to finance acquisitions recently. GameStop's 2025 EBITDA was $299 million, so it could have a net debt position of $1.196 billion while maintaining a ratio of 4x net debt to EBITDA. And if GameStop did buy another company, the new company's net debt to EBITDA ratio would also include the target's EBITDA as well. Recently, there have been rumors that GameStop might buy Best Buy. Best Buy is a huge electronics store chain, so I decided to check if this would even be possible. Best Buy has $2.6 billion in TTM EBITDA, so the combined company would have $2.9 billion in EBITDA. The merged company could borrow up to $11.604 billion, assuming a ratio of 4x net debt to EBITDA. Best Buy also has $1.89 billion in cash and $1.15 billion in long-term debt, so it has net cash of $740 million. God, that's actually so annoying that they do that, because I don't know what Best Buy's debt. Maybe it's more accurate with Best Buy, because maybe Best Buy's debt is not convertible notes or anything like that, but I just don't like people saying, the Steve Eisman dude said that too. It's just, you guys don't know what you're talking about. At that, to GameStop's $4.85 billion, and that merged company would have $5.59 billion in net cash. See, that just doesn't make sense. How can you say that just because they have debt, they have less cash? That just doesn't make any sense at all. So if GameStop merged with Best Buy, it would have $5.59 billion in cash to pay Best Buy's shareholders, and it could also borrow another $11.604 billion. Based on the merged company's earning power, so Best Buy could pay a total of $17.94 billion to Best Buy shareholders for their stock. Best Buy's EV on April 2nd was $15.69 billion, so it looks like a leveraged buyout of Best Buy by GameStop might be doable. And if Ryan Cohen lowered Best Buy's cost afterwards, its EBITDA would rise. So the combined company might have even more borrowing capacity. It'd be very speculative to invest in GameStop because an acquisition like this may be theoretically possible, But it does sound like investors are still discussing the possibility. I don't think that's the only reason to invest in GameStop, but whatever. GameStop is planning to buy a company soon. Even if GameStop doesn't try to buy Best Buy, it does sound like it will buy a company in 2026, and it's 10K. The company said shareholders should understand that our strategy is now explicitly focused on leveraging our cash, flexible capital structure, and stock to acquire assets that we believe will undergo a significant re-rating under our stewardship. So GameStop might also issue stock to acquire a company, and that would also make a large acquisition affordable. But it won't need to do that unless it buys a very large company. GameStop isn't going to close any more stores in 2026. And it's 10K. GameStop also said that it won't close any more stores in 2026. So GameStop's revenue won't drop in 2026 because of store closures, but its operating costs won't fall further because of store closures either. But GameStop is still making efficient improvements to its remaining stores, so its margins could improve a little bit in 2026 anyway. They did close stores in 2026. They closed 470 stores. So they're just not closing anymore, but they did close stores this year. GameStop didn't provide any 2026 guidance in its 10K, and it doesn't report comps for its game stores either, so there's no official information that I can use to forecast GameStop's 2026 sales, and it is still in the middle of a pivot as well. Additionally, GameStop still doesn't have any Wall Street analyst coverage. In my previous article, I projected that GameStop's revenue would fall in 2026 because I expected it to close stores, and now that's no longer true, but now it might be better to project that GameStop will report flat revenue growth in 2026. I think the first quarter revenue should potentially be down or flat because of the stores they closed at the beginning of the year, but they should have growing revenue from here on out. Except, 2027 is going to be an interesting year. There's a lot of leases that expire. GameStop's business model is a risk factor. GameStop brought up an unusual risk factor at its 10K. Regulators might decide that it's an investment company now. Right now, GameStop is classified as a retail store, but it is speculating on cryptocurrency, which isn't something that retail stores normally do, and it's also holding billions of dollars in other securities. So GameStop is not acting like a normal retail store in the mall, it's acting like an investment firm. And federal regulators might force GameStop to obey the rules for investment firms if they decide that it's not a retail store anymore. They would have to acquire a lot more assets than that. GameStop shareholders might not approve of this acquisition. Investors don't like some of the big M&A deals that have happened recently. McCormick's recent deal with Unilever caused both companies' stock to drop, and Cisco's announcement that it was buying Jetro Restaurant Depot also didn't go over very well. So if GameStop buys another large company, such as Best Buy, there's a possibility that both companies' stock prices will fall sharply. Regulators might also attempt to block the deal if GameStop's attempt to buy a direct competitor, such as Best Buy. I don't know anything about these other deals, but are those businesses profitable? Like, is Unilever profitable? Is Jetro Restaurant Depot profitable? I could see why it would go down if they weren't profitable, but if GameStop buys a growing profitable business, I don't know if I see the price dropping. If they buy some dog shit, sure, probably will drop. Updated comparative valuation for GameStop. I think it's probably better to use the EV to sales ratio for GameStop because its large cash balance affects its valuation. On April 2nd, GameStop had a TTM EV to sales of 1.53. Best Buy's TTM EV to sales was 0.38. So GameStop was still trading at a premium to its closest peer. The sector median for consumer discretionary companies was 1.26. So GameStop was also trading at a premium to the sector as a whole. This metric includes operating leases, but the other companies' EV figures also include their operating leases as well. Updated GameStop valuation. GameStop reported adjusted net income of $647.4 million in 2025. That's a 17.8% adjusted net margin, which is high for a store, but it sounds like collectible sales have boosted this company's margins. And again, I'm now projecting that GameStop's revenue will be flat in 2026 because it stopped closing stores. Because GameStop didn't provide any 2026 guidance, I project that an adjusted net margin and its profit will remain the same in 2026 as well. What, you're just going to forget about Power Packs, bro? That's crazy. They're about to make over $1 billion in net income this year. And their revenue will most likely be up, not flat. GameStop's adjusted net income is higher than its GAAP income, which was $418.4 million in 2025, but the company did report a lot of one-time expenses related to its store closures, so it's reasonable to use adjusted income here. Again, there's no forward PE available for this stock because it has no analyst coverage, but right now, the median forward PE for consumer discretionary companies is 16, so with a 2026 PE of 16, an adjusted net income of $647.4 million in 2026, GameStop would have a market cap of $10.358 billion. According to its 2025 10K, GameStop had 447.6 million shares outstanding at the end of the year, and if I divide 10.358 billion by 447.6 million shares, I get 1 year target price of $23.14 per share. GameStop's current share price is $23.36, so my target price is flat compared to the current price. So this company appears to be fairly valued right now. Yep, it is fairly valued, and your downside is potentially extremely limited because book value is like $13. Conclusion: I still think that GameStop's turnaround is working. Based on its recent results, the company appears to be fairly valued if you value it like a normal retail store that's pivoting, but it also appears that GameStop is planning to make an acquisition soon, and it might be a large acquisition, and that adds a lot of uncertainty. GameStop hasn't identified a buyout target, so it's not possible to predict what might happen. It might be better to wait and see what the company does, so I'd say that GameStop is still a hold. Why do people want to wait? Why would you wait until they announce the acquisition? What, because you think the stock's going to go down? What if it goes up? If it goes up on the acquisition, it's never going back down. So I just don't understand why people are like waiting and just, I don't know. It's weird. It's very weird. Everyone wants their hand held in the financial world, it seems like. What's up, Grady? Isn't it supposed to tell you at the bottom of the article if AI made it? I don't think so. I don't think so. I mean, realistically, I could just probably probably just copy and paste it into something and be like, did AI make this? Yeah, well, I could probably copy and paste the text or the web, whatever. Just go to ChatGPT or something. I know there's a website that actually like does this, but did AI create this article? I don't know if ChatGPT does this or not. Let's see. Article: GameStop short created market structure case. EBC Financial Group website appears to be a professionally written educational piece published by EBC itself, not content generated by an AI model available to the public. It's hosted directly on EBC's official domain, presented in multiple languages, and credited to Chad Carnegie as the author in the localized versions. Textile structure and publication context suggests it was created and published by EBC's research and content team, not by a freely operating AI system. There's no indication in the article that an AI wrote or co-authored it, and no AI attribution is listed anywhere on the page. If you can like I can analyze the writing patterns for signs of automated text generation. Yes. I have to have an account for you to do that? That's so stupid, bro. I would never make a ChatGPT account. I might actually already have one, but whatever. So maybe it's not. Okay, there's that. Still got an hour until the market closes. Yeah, I mean, I'm going to start, if I do continue to stream, I'm going to start the stream like now. Like whatever time it is where you guys are at, this is going to be the time I'm going to start the stream. I'm not starting the stream at 12 anymore. Like I can't sit here and read articles for 2 hours to nobody. Nobody's typing in the chat. Like, I don't know. It's just, it's whack. It's whack. It's whack. So from now on, this time right now is when the stream will start. And if anyone in the chat can verify this, GameStop stock opinions on Roaring Kitty's brother buy hint. Social media erupted after Roaring Kitty's brother hinted at purchasing GameStop or AMC shares, reigniting speculation among longtime holders. If anyone can verify that, verify it. But nobody's even typing in the chat, so I don't even think anyone's here. What's this? This is a Motley Fool article. I'm not gonna read that. This article's pretty good. And I still have a bunch. Still have a bunch of other articles to potentially read. I'm gonna go through those for a sec. Barking Puppy account replied to a tweet saying something like, "I'll make sure Keith returns." Interesting. Yeah, I don't trust that Barking Puppy account. They did a crypto scam, so I don't even think that's real. Did a crypto scam and tried to act like the account got hacked. I couldn't put any weight on that. The only reason I think Barking Puppy could be legit is that Christmas photo they posted, where it's like their whole family in the Christmas photo. But other than that, and you know, that could be easily photoshopped. I just can't put any weight on that. That's a crypto scam for sure. Let's see. Delete this. I don't think I'm going to read that one. This is literally the same article. What is this? No. Maybe it was hacked. Could have been. But I don't honestly, what is even if that is Roaring Kitty's real brother, how does that benefit me? It doesn't. It doesn't make me any more or less bullish. It literally does nothing for anyone. So, whether it's real or not, it's useless. But when you promote a coin and try to act like your account got hacked, I mean, seen that shit a million times. Nothing there. I don't want to read that one. I'm good on that one. And that one. And I'm good on that one. Why did I have all these articles saved? Did I already read this one? All these articles are bad. I don't know why I had all these saved. Doesn't seem like any of these are good. Yeah. I don't know why I had all these articles saved. Literally none of them looked good. Yeah, I guess I'll read this one and then hopefully it's about 2 by the time that's done. See what you're saying. Maybe it's just a grift, but I don't think that account can hurt the stock. It could only help. How does someone who promoted a crypto coin help? I don't. And also, people promoting or bashing GameStop it doesn't do anything. As much as the media wants to tell you that it does, it doesn't. So I don't think it helps or hurts the stock, but it is bad for the community because people are going to get scammed by stupid crypto coins. It's not even about the stock. It's about people getting scammed. The stock's going to do what the stock's going to do. It doesn't matter what Michael Burry says. I would argue it doesn't matter if Roaring Kitty even came back, because it doesn't, like, Roaring Kitty doesn't control the stock. Him posting a tweet isn't the reason the stock went up. It's not even realistic. So, anyone talking about the stock, whether it be good or bad, has nothing to do with the stock. The stock's going to do whatever. If, whether someone posts about it or not, it's going to go wherever it's going to go. But I don't like seeing people get scammed. Alright. Yes, let's read this. The transformation is complete. Now comes the deployment. Let's see. All right. Simple Man 88 okay. Simple Man 887 updated his GameStop article here. It's GameStop Corp fiscal year 2025 annual review. The transformation is complete. Now comes the deployment. Price target $220. Current price $23. April 2nd. Executive summary. GameStop's fiscal year 2025 ended January 31st, 2026, marks the definitive inflection point. The company posted $418.4 million in net income, a 219% increase over the prior year's $131.3 million on $3.63 billion in revenue. Operating income swung from a loss of $26.2 million to a profit of $232.1 million. Free cash flow hit $597.3 million. The cash pile reached $9.01 billion. SG&A expenses dropped another 19.5% to $910.2 million. These are not the numbers of a struggling retailer. These are the numbers of a company that has completed a surgical transformation under Ryan Cohen's leadership and is now sitting on a loaded balance sheet, waiting to deploy capital into a transformative acquisition. I really have nothing to say about Simple Man's analysis. This guy actually knows what he's talking about, so I probably won't say much about what he's writing, because I agree with most of the things he's saying. I maintain a $220 price target, representing approximately $99 billion in market capitalization, a figure that aligns precisely with the top tranche of Cohen's CEO Performance Award, a 100% performance-based stock option package that rewards him only if shareholders see the stock reach levels representing a 10x return from current prices. Cohen receives 0 salary, 0 cash bonuses, and 0 time vested equity. He gets paid only if shareholders get paid first. The 9-quarter transformation, let the numbers speak. The trajectory from Q4 2023 through Q4 fiscal year 25 tells a story that no narrative can obscure. Revenue declined from $1.79 billion to $1.1 billion on a comparable Q4 basis, a deliberate contraction reflecting 727 U.S. store closures in fiscal year 2025 alone, plus the complete exit from Canada, Germany, Italy, New Zealand, and pending exit from France, but every other metric moved in the opposite direction. Net income swung from a $32.3 million loss in Q1 fiscal year 24 to consistent profitability across every quarter of fiscal year 2025. $44.8 million in Q1, $168.6 million in Q2, $77.1 million in Q3, and $127.9 million in Q4. The cash position marched from $1 billion to $9.01 billion across the same period, a 9x increase. SG&A expenses dropped from $295.1 million per quarter to a range of $219 to $242 million, a structural reduction that persists regardless of revenue fluctuations. Full year fiscal 25, gross margin expanded to 33% from 29.1%, driven by the dramatic shift towards higher margin collectibles. Adjusted EBITDA reached $345.4 million, compared to $36.1 million in the prior year, an 857% improvement. That's insane. Didn't that Seeking Alpha article say their margin was like 17%? I trust Simple Man's analysis more than anyone else, to be fair. The company did not hold a single earnings call during fiscal year 2025. Cohen let the numbers do the talking. Bottom line over top line, the only metric that matters. Wall Street's bearish thesis on GameStop is always centered on one thing: declining revenue. Every quarter, without fail, the same headlines appear day after day, week after week. Revenue fail, sales are shrinking, the business is dying. Yep, pretty much. This fixation on top-line revenue is not just analytically lazy at this stage, it is suspicious. Not a single Wall Street analyst covers GameStop. 0. The most famous contrarian investor alive, Michael Burry, has made GME a 13% position in his portfolio. Ryan Cohen personally bought 1 million shares in January 2026. Directors Alan Attell and Lawrence Chang bought alongside him in the same week. And yet the institutional coverage vacuum persists. The question deserves to be asked directly: why does Wall Street refuse to cover a company with $9 billion in cash, $418 million in net income, $597 million in free cash flow, and 0 coupon debt. The absence of coverage itself is a signal. When no analyst publishes a price target, there's no institutional framework to guide a re-rating. It is how their system is designed. Retail investors are left navigating in the dark while legacy media amplifies the revenue narrative quarter after quarter. Who benefits from the vacuum? Not the shareholders. Now, I actually don't agree with that, because if you're a true shareholder of GameStop, you've already done your research. This does benefit you because it keeps the share price lower. Because if everyone understood where GameStop was going to be in the future, and the price would be up most likely. Potentially, not a for sure thing, but if the narrative is really what is like keeping the price low, that is a huge benefit to shareholders because we get to buy shares at a lower price. Let us be specific about why top-line revenue is the wrong metric. WeWork grew revenue from $886 million in 2017 to $3.4 billion in 2020. During that same period, it accumulated roughly $16 billion in lease obligations and filed for Chapter 11 bankruptcy in November 2023, with $18.65 billion in total liabilities against $15.06 billion in assets. Revenue growth without profitability is just burning cash with a marketing budget. Yep. That's what I've always said, man. Like, revenue does not matter. Profit is the only thing that matters. If your business is growing, your stock is most likely growing alongside. Peloton grew revenue from approximately $915 million in fiscal year 2019 to $4 billion in fiscal year 2021. The stock hit 171.09 in January 2021. By May 2024, the stock traded at $2.70, its all-time low. Revenue was a vanity metric that masked a structurally unprofitable business model. Yep. Carvana grew revenue to $13.6 billion in 2022, while simultaneously approaching insolvency. It took a brutal debt restructuring and near-death experience before the company refocused on profitability, the exact playbook GameStop executed proactively without the near-death part. Revenue growth without profit discipline is nothing more than organized cash destruction. GameStop chose the opposite path: shrink intelligently, cut ruthlessly, and accumulate capital for deployment. The results speak for itself. In fiscal year 2023, net income was $6.7 million. In fiscal year 2024, it was $131.3 million. In fiscal year 2025, it was $418.4 million. That is a 6,143% improvement in 2 years. Holy, yeah, that's a good point, bro. Dude, that's huge. That's huge when you put it in percentages. That's massive if you put it in percentages. Wow, 6,000? Good lord. The collectibles engine, 47.7% growth and a new revenue pillar. The most significant operational story in fiscal year 2025 is the collectibles segment. Revenue from collectibles, apparel, toys, trading cards, grading services surged 47.7% to $1.06 billion, growing from 18.8% to 29.2% of total revenue. In Q4 alone, collectibles hit $365 million, representing 33.1% of quarterly sales. This is not incremental. This is a structural transformation of the business mix. Collectibles carry significant higher margins than hardware or software, and they are not subject to the same digital distribution headwinds. Nobody downloads a graded Pokemon card. The 10K reveals a new initiative that received almost no media attention: Power Packs, a digital trading platform launched in partnership with Collector Holdings, parent of PSA, the professional sports authenticator. Power Packs lets collectors purchase graded PSA trading cards that are stored in the PSA vault with the ability to instantly sell back, trade, ship, or hold. Early in beta, results are described as promising, This is GameStop entering fintech adjacent territory through the collectibles channel. Meanwhile, hardware and accessories declined 12.3% to $1.84 billion, and software declined 27.5% to $729 million. The software decline reflects the industry-wide shift to digital downloads, a structural headwind that GameStop has acknowledged and is actively navigating by reducing exposure. However, the launch of Nintendo Switch 2 in June 2025 creates a new hardware cycle that should provide a tailwind for fiscal year 2026. Also, couldn't you say that, hardware and accessories and software sales are down also because they close stores? Like when they stop closing stores and cutting costs, these potentially will flatten out. I'm sure they'll still be declining, but it's not going to be as much. Missed point about revenue. A critical detail buried in the segment data, while total revenue fell 5.1% to $3.63 billion, U.S. revenue actually grew 3.6% to $2.67 billion, and Australia grew 22.2% to $494.7 million. The entire consolidated revenue decline is attributable to exited markets. Canada, 81.3%, and Europe, 32.7%. Strip out the divestitures, and the core business is growing. Yep. Dude, that's the first time I've seen anyone say that. God bless Simple Man, bro. This guy actually knows what he's talking about. The $9 billion balance sheet, a weapon, not a savings account. As of January 31st, 2026, cash and cash equivalents, $6.3 billion. Marketable securities, $2.7 billion. Total liquid assets is $9 billion, which potentially it's more because they have that $700 million in a separate account. I don't know that they're counting that, so it could be closer to $10 billion. Bitcoin-related receivables, $368.4 million. Stockholder equity, $5.4 billion, highest in company history, which is awesome. Whoa. Long-term debt, $4.1 billion, entirely zero coupon convertible notes. Yep. Shares outstanding, 448,375,157. The cash position of $9.01 billion represents approximately 20.1 per share in liquid assets alone. At a share price of $23, investors are paying roughly $3 per share for the entire operating business, the brand, the 2,206 stores, the collectibles platforms, the grading services partnership with PSA, and the strategically optionality of a $9 billion war chest. And also, earnings is lagging information. So, GameStop is... When you're seeing an earnings report, you're seeing what GameStop was 3, 4, 5 months ago. So GameStop, as of this moment right now, could be already sitting on 10 billion cash, and it could be bigger and more profitable than what the market is seeing, because most of the information GameStop is providing is lagging information. The 4.2 billion in convertible notes deserve specific attention. These were issued in 2 tranches, 1.5 billion due 2030 and 2.25 billion due 2032, both at 0% interest. GameStop pays nothing to service this debt, not a cent in coupon payments. The market accepted zero return because of the conversion premium. The right to convert into equity at a price above the current market was sufficient incentive. Now contrast this with what is happening elsewhere. OpenAI, arguably the most hyped company on the planet, is reportedly offering private equity firms a guaranteed minimum return of 17.5% just to attract capital, while simultaneously burning an estimated $14 billion annually and requiring hundreds of billions more in infrastructure financing. OpenAI's own data center partners have accumulated approximately $100 billion in debt, with Oracle's bonds trading at a credit default swap spreads not seen since 2009. GameStop raised $4.2 billion for free. OpenAI has to guarantee 17.5% returns to attract sophisticated investors. WeWork paid 7.88% on junk bonds before going bankrupt. This tells you everything you need to know about which balance sheet the market actually trusts, regardless of what the Wall Street headlines say. Damn, dude, Simple Man is cooking, bro. Simple Man is cooking, bro. The interest income alone generated $271.5 million in fiscal year 2025, net of $42.2 million in non-cash warrant expense. GameStop is earning more from its cash pile than most mid-cap companies earn in operating profit. Yep. And all anyone will talk about is how GameStop's cash is irrelevant and now how if they don't deploy it, it has no value. Yet the whole market's crashing and GameStop is absolutely crushing by holding cash. Oh man, this is a great article. I love Simple Man's analysis. He's the only person I have read that actually understands GameStop's business. Bitcoin, a measured bet, not a YOLO. GameStop purchased 4,710 Bitcoin for $500 million during Q2 fiscal year 2025. By the end of the fiscal year, the Bitcoin position was valued at $368.4 million, reflecting a $131.6 million total loss on digital assets and related receivables. This sounds painful, but context matters. The $500 million investment represents 5.6% of the $9 billion cash position. GameStop did not lever up to buy Bitcoin. It did not bend the balance sheet. It allocated a measured portion of its treasury to a speculative asset with asymmetric upside and absorbed the downside without any material impact on operations. Yep. The $131.6 million loss, while real, is roughly equivalent to 7 weeks of interest income. And also the loss made it seem like they made less money on their earnings. So in a lot of ways, the Bitcoin loss is extremely valuable. And they did the covered call sales, which I assume he's going to talk about. In Q4, GameStop entered a covered call strategy with Coinbase Credit, pledging 4,709 Bitcoin as collateral. The counterparty has rehypothecation rights. Why can I not say that word, man? Meaning Coinbase can reuse the pledged Bitcoin. GameStop de-recognized the Bitcoin as an intangible asset and reclassified it as a digital asset receivable. This is a sophisticated income-generating strategy, not a simple buy and hold, though it does introduce counterparty risk that investors should monitor. Burry's own assessment is instructive. I do not know about this Bitcoin thing, but I cannot argue with what has been done so far. And yeah, nobody even knows how much they made on those covered calls. GameStop could actually be profitable on their Bitcoin position. It could be flat. Yet to see. Ryan Cohen, alignment without precedent. On January 6, 2026, GameStop disclosed a CEO Performance Award to Ryan Cohen, consisting entirely of performance-based non-qualified stock options on approximately 171.5 million shares at a fixed exercise price of $20.66 per share. The award is subject to stockholder approval at the upcoming annual meeting. This is not a share grant. Cohen does not receive a single share for free. The options become exercisable only upon achieving 9 cumulative milestones tied to market capitalization, reaching $100 billion, and cumulative performance EBITDA reaching $10 billion. Also, people are talking about how GameStop didn't provide guidance. In a lot of ways, the share compensation plan is guidance. In the next 10 years, GameStop is expecting, the shares to be trading at 100 billion market cap. And I mean, in my opinion, it'll probably be trading that sooner, but we'll see. If and when those milestones are met, Cohen earns the right to buy shares at $20.66, meaning he must deploy his own capital to exercise. If the stock is at $220 when a tranche becomes exercisable, Cohen pays $20.66 per share, and the difference represents as a reward for delivering that value. The exercise proceeds flow back into GameStop's treasury, adding cash to the balance sheet. If the milestones are never met, the options expire worthless, and Cohen receives nothing. Cohen receives no salary, no bonuses, no time vested equity, zero compensation unless shareholders see the stock reach levels that would represent a 10x return from current prices. Yes, exercise options create dilution, but it is dilution that only occurs in a scenario where every existing shareholder has already made multiples on their investment. The options are worthless at $23. They only matter at $100 plus per share. This is the definition of aligned incentives. Cohen gets rich only after shareholders get rich first. Yep. And also, it's not dilution at all because the stock price is going to be so high and he's going to be buying the shares at such a low price, it's not even going to matter. Cohen also personally purchased 1 million shares in January 2026 across 2 consecutive days, 500,000 shares at 21.12 on January 20th, and another 500,000 at 21.6 on January 21st, a total outlay of approximately $21.4 million. This brought his direct ownership to 38,347,842 shares, with total beneficial ownership of approximately 42.1 million shares, 9.3% of the company. In his SEC filing, he stated that CEOs who do not buy their own company's stock with personal funds should be fired. 3 board members bought alongside him in the same week. Director Alan Attell purchased 24,000 shares across 2 transactions, and Director Lawrence Chang purchased 5,000 shares through Chang Capital LLC. In total, insiders committed nearly $22 million in open market purchases within a 4-day window in January 2026. Yeah, that's huge. Retail shareholders. Conviction is read in registered form. The insider buying is mirrored by an equally committed retail shareholder base. As of March 18th, 2026, approximately 66.2 million shares, 15% outstanding, were held by registered holders with Computershare, GameStop's transfer agent. The vast majority of these are directly registered shares, removed from the DTC system, and held in individual investors' names rather than in street name through brokers. This structural commitment limits the shares available for lending and short selling, providing a stability floor during periods of volatility. The 177,522 record holders represents one of the largest directly registered shareholder bases of any public company. These are not passive index fund allocations. Each registration requires the shareholder to actively request the transfer from their broker, a deliberate manual act of long-term conviction. When 15% of a company's shares are locked away in registered form by an individual investor who went out of their way to do it, that is not speculation, that is ownership. I don't know if it's 177,000 people directly registered. I think that's just how many holders there are in general, but I'm not sure on that. Michael Burry, the smart money has arrived. The man who shorted the housing market before 2008 and was right when everyone has said he was wrong is now long GameStop. Dr. Michael Burry disclosed on January 26, 2026 via his Substack that he has been accumulating GME shares as a long-term value investment at approximately 1x tangible book value. As of recent communications, GME represents 13% of his portfolio. Burry's thesis is not about a short squeeze. He explicitly stated, "I am not counting on a short squeeze to realize long-term value. I believe in Ryan. I like the setup, the governance, the strategy as I see it. I am willing to hold long-term." He described Cohen as making lemonade out of lemons, acknowledging the weak retail business while praising the use of the meme phenomena to build the war chest. Burry drew comparisons to Warren Buffett's early strategy with Berkshire Hathaway, suggesting GameStop could evolve into a holding company supported by its cash position. In early March 2026, Burry publicly listed potential acquisition targets he believes GameStop should evaluate, and the stock jumped 8% on that news alone. Debatable, that's why the stock went up, but maybe. Wall Street analysts may refuse to cover GameStop, but the man who correctly predicted the 2008 crisis is allocating 13% of his capital to it. The turnaround operator thesis, not Berkshire, something different. There's been considerable speculation that GameStop will become the next Berkshire Hathaway. I respectively disagree. I believe Cohen's model is more accurately described as a turnaround acquisition vehicle, a company that identifies bloated legacy businesses with strong underlying infrastructure, acquire them at a reasonable valuations, strip out the embedded incompetence derived from decades of unchallenged organizational drift, and unlocks value through operational discipline. This is speculative. I do not have inside information. This is based on how I read Cohen's operating philosophy and the 10K's explicit language about control transactions and transformational acquisitions. Consider his track record. Cohen built Chewy from 0 to $3.5 billion in revenue and a $3.35 billion acquisition in 6 years, the largest e-commerce deal in U.S. history at the time. Chewy later IPO'd at about $8.7 billion. At GameStop, he took a company losing $32 million per quarter and turned it into one generating $418 million annually in net income, while closing over 1,000 stores and exiting several international markets. 7. Now consider the landscape of potential targets. Companies like eBay, PayPal, or legacy authentication services like PSA have enormous user bases, established payment infrastructure, and brand recognition. They also have bloated cost structures, poor user experience relative to modern standards, and organizational complexity that accumulated over decades of legacy management. They all work, but none of them are working efficiently. The fees are high, the interfaces are dated, the synergies between adjacent platforms remain unrealized. Now imagine someone like Cohen acquiring one or more of these types of businesses, cut the corporate bloat, modernize the user experience, integrate the payment and authentication infrastructure, cross-sell into GameStop's existing collectibles and grading ecosystem. The 10K's own language is remarkably direct. We view our significant cash and other sources of liquidity as a strategic asset to be deployed into acquisitions and control transactions that offer long-term value. The investment committee, Cohen plus 2 independent directors, has delegated authority to act with speed. The forward-looking statement on acquisitions state they are actively evaluating opportunities that could require significant capital deployment. If capital is deployed correctly into the type of turnaround bundle, cleaning the operational inefficiency of legacy platforms while unlocking synergies, the probability of GameStop becoming a 10x or even a 20x stock increases meaningfully. $220 price target, the math. At $220 per share on 448 million shares outstanding, GameStop's market capitalization would be approximately $98.6 billion. This aligns with the top tranche of Cohen's performance award, the point at which his options become fully exercisable and he can purchase shares at $20.66, with exercise proceeds flowing back into the company treasury. The supporting framework, floor value, cash and liquid securities of $9.01 billion plus Bitcoin holdings of $368 million equals approximately $20.93 per share. At $23, you're paying less than $3 per share for the operating business. Burry is buying at essentially 1x tangible book value. Operating earnings power. Fiscal year 2025 adjusted net income was $647.4 million, or 1.818 per diluted share. At a 25x forward PE, reasonable for a company with this growth trajectory and optionality. The operating business alone justifies $29.50 per share, already above the current price before any acquisition premium. Interest income, $271.5 million net in fiscal year 2025 alone. This alone, capitalized at 15x, is worth $9.06 per share. Acquisition optionality. The $220 target requires GameStop to successfully deploy its capital into transformative acquisitions that generate meaningful earnings growth. This is where the risk is. and this is where the reward is. A single accredited acquisition generating $500 million in EBITDA at a 15x multiple would add $16.74 per share. 2 or 3 such acquisitions, combined with operational improvement, could reasonably get GameStop into the 80 to 120 range for fundamentals alone, with squeeze mechanics and index inclusion providing additional catalysts. S&P 500 eligibility. GameStop has satisfied the profitability requirements for the S&P 500 inclusion. The remaining barrier is the market cap threshold of approximately $22.7 billion as of mid-2025. If GameStop executes a significant acquisition and the market re-rates accordingly, index inclusion would trigger mandatory buying from billions in passive AUM. The $220 target is ambitious. It requires flawless execution and favorable market conditions, but it is not unreasonable given the unique confluence of a $9 billion war chest, a CEO whose entire compensation depends on reaching $100 billion, insider buying from both the CEO and one of history's most celebrated contrarian investors, 66 million directly registered shares held by 177,522 committed retail investors, and a retail shareholder base that has proven its conviction over 5 years. Risks. I am bullish, not blind. Risk. Revenue continues to decline in the legacy retail business. Digital distribution of games is a permanent structural headwind. If collectibles growth stalls, which can happen in any consumer trend, margin expansion reverses. Bitcoin holdings introduce cryptocurrency volatility. The covered call strategy with Coinbase adds counterparty risk. The 131.6 million loss on fiscal year 2025 is a reminder that this asset class cuts both ways. The 4.2 billion in convertible notes, while zero coupon, represent potential dilution upon conversion. The warrant distribution added approximately 59 million additional shares that could enter the market if exercised at $32. Actually, in the 10K, it says this wouldn't be dilution because putting shares on the market at $32 would be a premium to what the business is actually worth. I can't remember the exact language, but it says in the 10K that the distribution of shares from the warrants and the notes wouldn't technically be dilution. Cohen CEO Performance Award, if all milestones are achieved and options fully exercised, would add approximately 171.5 million shares, though this only occurs in a scenario where the market cap has reached 100 billion, meaning existing shareholders would already be sitting on approximately 10x returns. Oh man, I hope so. I hope so. Oh, that would be beautiful. That would be a beautiful thing. Execution risk on acquisitions is the single largest risk to the bull thesis. Deploying $9 billion wisely is harder than accumulating it. Yeah, I agree. I can agree with that. Market narrative games persist. The 22% stock drop following the June 2025 bond announcement was driven by standard convertible bond hedging mechanics. Yep. Arbitrators, people who arbitrage, shorting the underlying stock to hedge their conversion exposure, not by a fundamental rejection of the strategy. However, legacy media framed it as a loss of confidence, which is precisely the kind of narrative distortion that persists in the absence of analyst coverage. With zero institutional coverage, there's no professional counterweight to correct these mischaracterizations, leaving retail investors to navigate misleading headlines on their own. This is a risk because not everyone sees through a more elaborated perspective, and most people just want their hands held through investing because they can't think for themselves. I mean, that's just in general. Conclusion. The numbers in fiscal year 2025 are no longer early signals of a turnaround. They are the completed transformation. Net income of 418 million, free cash flow of 597 million, gross margins at 33%, SG&A cut by 220 million in a single year, 9 billion in cash with zero interest expense on the debt. Ryan Cohen has 0 salary and 42 million shares. His stock options pay nothing unless GameStop reaches 100 billion, and even then, he has to buy the shares with his own money. Michael Burry has 13% of his portfolio in GME. 3 board members bought alongside Cohen in the same week. 66 million shares are directly registered by 177,522 retail investors who chose to put their names on the certificates. Every quarter, Wall Street says revenue is declining. Every quarter, the bottom line gets stronger and the cash pile gets larger. Every quarter, the same outlets that champion WeWork's revenue growth and Peloton subscriber count refuse to acknowledge what is happening in Grapevine, Texas. As Cohen himself put it, short sellers are the dumb stormtroopers of the investing galaxy. They keep shooting, they keep missing. This review reflects my personal analysis. I maintain a long position in GME. This is not financial advice. Do your own due diligence. Simple Man 887, man. Keep writing these articles, dude. Your articles are the best, bro. They are the best. Your analysis, your research. I haven't seen anyone who tops it. So keep at it, Simple Man. Oh, that was great. That was great. What's up, Isaiah? How you doing, bro? I dream. I did. That was like the first thing I did when I hopped on stream, Grady. I already did that. All right. I guess it's Levi time, I guess. When do they... Oh, their earnings call isn't till later? That sucks. Sorry, I missed it. Oh, you're good, bro. That's just literally the first thing, or maybe the second thing I did when I started the stream. What's up, Snakes? How you doing, man? Hope you're good. Hope you're good. Hope you guys all had a good weekend, a good Easter. Let's see. Levi Investor Relations. Relations. Nice. Nice. All right. Let's see. Annual meeting of shareholders? Wait, they're having their annual meeting as the earnings call? That's interesting. I've never seen that, I don't think. 10:30 a.m. Wait, Pacific time. What is that? So they already did it? I'm confused by that. First quarter. Oh, I for some reason I thought it was. This says April 27th. All right, I'm an idiot. I'm an idiot. For some reason I thought it was April 22nd today. Oh, that's kind of sad. That's kind of sad. I don't even know what day it is, bro. I don't even know what day it is, man. Okay. We're good to go. We got it. We got it. I'll duplicate the tab so I can have the earnings call thing, or the whenever the earnings gets dropped. Okay. We're good to go. We're good to go. We're good to go. I doubt there will be that many people here for this. I don't think Levi is a popular stock, but tomorrow should be good. Tomorrow should be good. Where is everyone, though? Where's like Moose? Where's everyone? Like, nobody is here today. I mean, there's a couple people here. Appreciate everyone who's here and people who typed in the chat. It's always good to see your guys' names, but what happened? What happened to everyone? Keep working and stacking. Nice. Do it every year, the first quarter. Yeah, I was just looking at the wrong thing. I was just looking at the wrong thing. I didn't... Whoops! Oh, whoops. Five minutes till the market closes. Is there anything on Reddit about that thing? I don't know. Grady in the chat said, Barking Puppy said something, but you would think you would see this on Reddit. I don't know. Probably got deleted or something. I mean, I could maybe look it up. I just don't know his handle. And usually when you look up X accounts without an account yourself, it doesn't give you like up-to-date posts. How long have we been streaming? 2 hours? Yeah. Got some okay stream clips, I guess. I just don't know why the stream's so dead, bro. I feel like we used to have a pretty active chat. But not anymore. It kind of sucks. I like the active chat. I like when you guys you know, contribute to the conversation, because then I don't have to do everything. And even though it says there's 10 people here, it's like, is there actually 10 people here? Very debatable, very debatable. Always messing around doing something, so I just throw on and listen. Yeah, I think that's the case for a lot of people. It just sucks not having chatters. Like, I get that people are busy. I get that people are busy and working. Most people are working, but I don't know. It would just be cool to have chatters. See my comments on your videos? I think so. I don't know. I try not to read comments too often, because most of them are negative. Surprise, surprise. Most of the comments I get are negative. No, I don't see any of your comments. Well, there's one from 11 days ago. There's none in held, so I'm not sure what's going on there. Maybe they're blocking my comments. Who knows? I am shadow banned, so like if you go on YouTube and you type my name, it doesn't show up. So wouldn't be surprised if they were, you know, blocking comments and stuff as well. So like it doesn't even show up. If you press enter, it shows up, but my name should show up in the search bar. It's whack, bro. It's whack. when people FOMO in at 30, the chat will pop. That's true. That's true, but it's not going to be with the people that we want around, you know? It's going to be a bunch of gambling degenerates who are just FOMOing into the stock and are probably going to get wrecked. It's, you know, it's not the people that we want around. We'll see, though. We'll see. I mean, that could be part of it, though. You know, people could be losing patience. It's been a long journey so far. I wouldn't expect most people to be able to survive this long with an investment that doesn't move. Especially, you know, when you're seeing the market. There's been a lot of opportunities in the market, so I think it would be tough for anyone to just sit and hold this investment and be positive about it. 3.5 years for me, but I don't give a fuck. Oh, that's good, bro. That's good. It's because you see the vision, I suppose. You see the potential future. I wouldn't expect most people to be able to see that. And it's been a tough year and a half, so people are maybe moving on to getting new jobs or something. A lot can happen in a year and a half, so like KCR, one of the dudes who was in here a lot, he has like a girlfriend now and he's living his best life. So like, you know, we'll see him sometimes, but that's someone who is here daily, all the time, active in the chat, that probably won't really be around anymore. It's just how it goes. That's just how streaming goes, I suppose. It's always a constant influx of people finding the stream and leaving. You know, there's been people that were in the chat from when I used to stream like 5-6 years ago. I haven't seen them in a long time. Also, people probably get tired of me. You know, I'm sure they get tired of me as well. Seems to be a popular thing in my life. Gamestop before girlfriend. I mean, debatable. Wouldn't you want to get a girlfriend like before you get rich? Because all the girls that are going to come after, you know, maybe, you know, if you get rich. I won't say when. I'll say if. All the girls that come after you get rich, they're just going to be nasty. They're just going to be gross. So I think getting a girlfriend before you're rich has a lot of benefits. I'm engaged. She knows the deal. There you go. Clutched up, bro. You're clutched up. I'm gonna be screwed. I'm gonna be alone now and after I get rich. And it's gonna be worse. Because, I don't know. I feel like I feel like if it actually works out and I do get rich, I'm not gonna be able to trust anyone. So that's gonna be a problem. That's gonna be a problem. Get a couple of Colombians. Yeah, I'll have to get some girl that doesn't even speak English or something. Damn, nobody's gonna come here for Levi earnings? That's crazy. That's crazy. Is there people streaming this? Is there other people? Nobody's streaming this. Why, I don't... I guess nobody cares about Levi. That's crazy. That's crazy. There's no Levi shareholders out there. No Levi shareholders. Do I even do the stream clip then? The earnings aren't even out yet. I don't think. Maybe they are. You can trust me. Well, thank you, AA. Thank you, AA Ron. Appreciate that, bro. Appreciate that, bro. What's up, Hugh G? How you doing, bro? I only got one, but working my way up to a couple. I feel like your girlfriend would beat your ass if she saw you type that. You'd be in the doghouse for sure if she saw that message. You'd be sleeping on the couch, bro. You'd be a couch surfer for the next like week. He's seeking Chanclaw. Wait, what's a Chanclaw? What the hell's a Chanclaw? What is that? He's seeking Chanclaw. What the fuck is a Chanclaw? What the fuck is that? I've never heard anyone say that. What is that? A Chanclaw? Oh. I didn't know that was a thing. They're just some sandals. Oh man. Their shoes, and they use that shit like a boomerang. I've never heard of those until now. I didn't know Chanclaws were a thing. That's new. That's new to me. Incoming Chanclaw. Beep 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 beep. GME finally hitting 10 million shares traded. Did it? I like never check the volume anymore. That's pretty good. Was a majority of them traded off that little spike? I don't know if TradingView has accurate volume or not. Go on the daily. A lot of volume after hour. Yeah. Yeah, seems like quite a bit of volume off that little spike there. It only says 31K on TradingView though, so I don't know how accurate that is. Where is this? How come Levi's not reporting it? Latina Chancla, and I'm sure you'd see millions of men suffering my same pain. I looked them up. I looked them up. I just didn't look up a video. I've seen those things. I've seen those slipper things before. Slipper, shoe, whatever you want to call them. Oh yeah, Muma ended his membership, so I guess we're not seeing him again. He ended his membership. I mean, maybe we'll see him again, but him ending his membership kind of tells me he's not coming back. Now, I'm not really sure like what I said or what I did. I don't remember doing anything. I just remember being like really pissed off one stream, just like almost ended it immediately after getting on, but like I don't remember if I like said anything or so I don't know what happened. Oh, there we go. There's Levi. There's Levi. Let's hit this stream clip. Let's hit this stream clip. Levi's up over 4% and I shorted it. Oh, dude, this is not good. I put so much money on puts and now we're getting absolutely wrecked. No! It wasn't even over 4% when I did the clip. Oh well. Oh well. Yeah, I mean, hopefully he's good. Hopefully it's just something I said or something and he just doesn't want to be a part of the stream anymore. Hopefully that's the case. Hopefully nothing bad happened or anything like that. Oh, it's still going up. I'll do another one, I guess. Because it is ripping. Ripping. Oh my gosh, it's crushing. Oh no, dude, I shouldn't have bet all those puts on Levi. It's up over 6%. Oh, this is so bad. I'm losing so much money. This is not good. Chat. Those stream clips are so dumb. They're so dumb. They're just, I don't know, they're dumb, but they're funny. No, dude, I shouldn't have bet all those puts on Levi. It's up over 6%. Oh, this is so bad. I'm losing so much money. This is not good. Chat. Who knows? Moom is a good dude. He'll be fine whatever he's doing. I only pop in here and there these days because I'm trying to stay productive. Yeah, you're unemployed right now, dude. That shit sucks. Have you been like looking for work or anything? But yeah, he'll be fine. He'll be fine for sure. It just sucks, you know? Someone who's here every single day, super active in the chat, and then they're just gone. Like, that sucks, man. That sucks. It really sucks. You know, the reason I still, you know, the reason why I hop on this stream is for the people who come here every day, and, you know, when people leave, it sucks, man. Especially lately, like, the chat has been dead, bro. The chat is so dead. It sucks. Let's see. Levi announces that after a planned transition, Chief Financial and Growth Officer Harmit Singh will retire. And then they got their earnings report here. I'll read it in a second. Let me get this YouTube short out real quick. The one thing I love about the YouTube short stream clips is I don't have to make a thumbnail. It's very convenient. What is this? Q1 26? Oh, wait. Like, in a lot of ways, it makes me not want to stream, you know? When people leave like that, it's like, what am I, what am I doing wrong? Like, someone who's here all day, every day, super active in the chat, leaves, like, it's like, fuck, dude, what am I doing? What am I doing? Like, is that how it's gonna be, for the next 5-10 years if I keep doing this? Just gonna be stagnant? Like, I don't know. It just makes me think super negatively, so it sucks when people leave like that. Alright. Wait, what the? Oh no. I didn't even upload it as a short. I'm so stupid, dude. Ugh. I forgot to... God damn it. I didn't even upload it as a short. I'm so dumb, bro. I forgot to... I forgot to change the resolution. Whoops. Forgot to change the resolution. You kind of got to do that. That's a very important piece of this. It's so annoying. I can't believe I did that. My bad. My bad, chat. Let me redo this, I guess, real quick. No, dude, I shouldn't have bet all those puts on Levi. It's up over 6%. All right, good enough. Good enough. That'll do, pig. That'll do, pig. I can't believe I just uploaded that as a video. That was not smart. Hopefully that doesn't affect anything. My bad. I'll get to the earnings in a second. I don't even think anyone's here for Levi earnings anyway, so probably doesn't matter how long I take. There we go. We're back. We're back in the game. And I didn't add a related video, so. Okay. Okay. Get it together. I'm trying, bro. I'm trying. I'm trying. All right. Oh, that's going to take a minute to check. Let's see. All right. Levi Strauss & Co. reports first quarter results. Sales margins and EPS above guidance. Reported net revenues up 14%. Organic net revenues up 9%. Continuing operations diluted EPS of 0.45. Adjusted diluted EPS of 0.42. Company raises full year 2026 net revenue, margins, and EPS outlook. Chief Financial and Growth Officer Harmit Singh will retire after a planned transition. Levi Strauss today announced financial results for the first quarter ended March 1st, 2026. We delivered very strong financial performance in the first quarter, driven by broad-based growth across channels, regions, and categories, said Michelle Gass, President and CEO of Levi Strauss & Co. Our evolution into a DTC first denim lifestyle brand is allowing us to capture a much larger addressable market and deliver faster and more consistent growth. Today we are operating from a stronger foundation, executing with focus and intention, with more ways to win than ever before. Okay, I got the stream clip up now. Don't you worry, I got it. I got it. How's that? Is that Berkshire video dying? Yeah, it's not getting as many views. That Berkshire video was crushing, dude. Let's see. We are pleased to report first quarter revenue, margin, and EPS above our guidance, said Harmit Singh, Chief Financial and Growth Officer of Levi Strauss. Our strategic transformation is translating into higher returns and more profitable growth, enabling us to convert more of our strong revenue growth into bottom line profit. Our great start to the year in Q1 and positive quarter-to-date trends gives us the confidence to raise our full-year sales, margins, and EPS guidance, even as we remain prudent about our external environment. Saw my Gamestop PSA submission finally made progress, submitted Jan 10th, entered grading on Saturday, just moved to assembly today. Maybe I'll get them back by the end of the month. Maybe. I've read that assembly could take like 2 to 3 weeks, but hopefully you get them back soon. Financial highlights for the first quarter. Oh wait, I keep forgetting that it's a new month. I was, yeah. My brain is like retarded right now. So yeah, in 2 or 3 weeks will be the end of the month. God, I'm an idiot. Net revenues of $1.7 billion increased 14% on a reported basis and 9% on an organic basis versus Q1 2025. In the Americas, net revenues increased 9% on a reported basis and increased 7% on an organic basis. Within the Americas, the U.S. increased 4% on a reported basis and organic basis. In Europe, net revenues increased 24% on a reported basis and 10% on an organic basis. In Asia, net revenues increased 13% on a reported basis and 12% on an organic basis. Beyond Yoga increased 23% on a reported and organic basis. DTC, direct-to-consumer, net revenues increased 16% on a reported basis and 10% on an organic basis. DTC growth on a reported basis reflected a 10% increase in the US, a 19% increase in Europe, and an 18% increase in Asia. DTC growth on an organic basis reflected a 10% increase in the US, 5% increase in Europe, and a 16% increase in Asia. Net revenues from e-commerce grew 21% on a reported basis and 17% on an organic basis. DTC comparable sales growth was 7%. DTC comprised 52% of total net revenues in the first quarter. Wholesale net revenues increased 12% on a reported basis and 8% on an organic basis. Operating margin was 11.4% in Q1 2026, compared to 12.5% in Q1 2025. Adjusted EBIT margin was 12.5% in Q1 2026, compared to 13.4% in Q1 2025, reflecting the impact of tariffs and planned increases in advertising. Gross margin was 61.9% compared to 62.1% in Q1 2025, primarily due to the impact of tariffs, partially offset by price increases and less promotional activity. Selling, general, and administrative expenses were $872 million, compared to $749 million in Q1 2025. Adjusted SG&A expenses were up 15.7% to $861 million, compared to $744 million last year, primarily due to the planned higher advertising costs in connection with the launch of the Behind Every Original campaign and the higher than expected sales volume and foreign exchange. Interest and other income expense net, which includes foreign exchange gains and losses, were income of $30 million and expenses of $15 million in aggregate in Q1 2026 and Q1 2025, respectively. The effective income tax rate was 22.4% compared to 20.6% in Q1 2025. Net income from continuing operations was $177 million compared to $140 million in Q1 2025. Adjusted net income was $167 million compared to $150 million in Q1 2025. So maybe their business is growing. I'm not, at least in Q1. Diluted earnings per share from continuing operations was 0.45 compared to 0.35 in Q1 2025. Adjusted diluted earnings per share was 0.42 compared to 0.38 in Q1 2025. And they have a lot of info here. There's a new Magic the Gathering set. I don't know. I know you're a Pokemon guy, but if you're into collecting sealed, Strixhaven, there's the Gathering Secrets of Strixhaven special codex bundle. Like things like this and like the Ninja Turtle pizza box. TMNT Magic. I think the pizza box is already out. Like stuff like this could potentially be a good investment long term because they're like exclusive drops to these drops. But I don't know. Maybe just something to look into if it's interesting to you. The collector boxes are interesting as well, but I just think the specialty, like this is the bundle box and the whatever this is, codex bundle, I think those would be better like long-term investments potentially. Well, booster box would probably be the best actually, but I think it's up for debate. But there's a new Magic set coming out. I don't think people are as interested in Magic as they are Pokemon. I actually bought a Commander deck to play some Magic out of that new set, but it doesn't come out to the end of the month. Let's see. Cash and cash equivalents were $717 million, while total liquidity was approximately $1.6 billion. Total inventories decreased 4% on a dollar basis compared to Q1 2025. Docker sale. On July 31st, 2025, the company sold the Dockers intellectual property and operations in the US and Canada. The company completed the sale of the remaining Dockers operations in multiple closings during the first quarter of 2026, with the final closing on February 27th, 2026. Leadership update. And yeah, that's about Harmit Singh. Oh, wait. Announced that Executive Vice President and Chief Financial Growth Officer Harmit Singh will continue in his role as CFGO until a successor is appointed, and then transition to serve as a special advisor, following which he will retire. Has initiated a search for his successor. Okay. Shareholder returns. In the first quarter, the company returned $214 million to shareholders, a 163% increase over the prior year. Oh, wow. That's actually huge because Levi's stock is down. Well, it was. Dividends of $54 million, representing a dividend of 0.14 per share, up 5% from the prior year. The company launched a $200 million accelerated share repurchase program and took delivery of and retired approximately 8 million shares, which had an aggregate cost of $160 million based on the January 29th, 2026 closing share price. The remaining shares are expected to be settled at the end of the program. As of March 1st, 2026, the company had $240 million remaining under its current share repurchase authorization, which has no expiration date. The company declared a dividend of 0.14 per share, totaling approximately $54 million, payable in cash on May 6, 2026, to the holders of record of Class A common stock and Class B common stock at the close of business on April 22nd, 2026. Fiscal 2026 guidance. Guidance for 2026 is based on continuing operations, reflecting the Dockers business being reported in discontinued operations. Guidance assumes U.S. tariffs on imports from China remain at 30% and the rest of the world at 20%. Following guidance is provided for the year ending November 29th, 2026. Reported net revenue growth raised to 5.5% to 6.5%, up from 5% to 6%. Organic net revenue growth raised to 4.5% to 5.5%, up from 4% to 5%. Gross margin raised to flat to slightly up for the prior year. From the prior year, up from flat to prior year. Wait, raised to flat to slightly up to prior year, up from flat to prior year. Oh, okay. Adjusted EBIT margin raised to expanding to approximately 12%, up from 11.8% to 12%. Tax rate approximately 23%, 2 points higher than the prior year. Adjusted diluted EPS raised to 1.42 to 1.48, up from 1.4 to 1.46. This includes an approximate 0.04 headwind from a higher tax rate. This outlook also assumes no significant worsening of macroeconomic pressures on the consumer, inflationary pressures, supply chain disruptions, potential tariffs or currency fluctuations. Reconciliation of non-GAAP forward-looking information to the corresponding GAAP measures cannot be provided without unreasonable efforts due to the challenge in quantifying various items, including but not limited to the effect of foreign currency fluctuations, taxes, potential tariffs, and any future restructuring-related severance and other charges. And I don't think we need most of this stuff, but let's see. Their assets are down. They sold property. Yeah, Levi's weird, bro. Their stockholder equity's down. What is their market cap? 7.6? Yeah, I don't... Levi's a weird... It's kind of weird. It's kind of a weird one. It looks good, though. Not bad. Could be worse. It definitely could be worse. All right. And the earnings call starts in a little bit, but there's like nobody here for this. I'll let it run, but I don't know, man. Streaming is just so depressing sometimes. Ugh. Ugh. Yeah, the short's not really doing anything. Maybe it'll ramp up, but who knows? Who knows? The only reason I really stopped posting for the past week is because that Berkshire video is doing so good. It's like nothing I post or any stream is ever gonna compare to that. So I just let it run. It's crazy. It was getting like over 100, 200 views an hour at one point. That video crushed. But doesn't grow the stream. Doesn't grow the channel. As you can see. you can get 16,000 views on a video and nobody cares. Did I say 6,000? I meant 16,000. A little bit more dramatic. Still got 25 minutes till this starts. I don't know what to do for 25 minutes. It's a rip. It's a rip. We can check Reddit, I guess, but we already know there's nothing on there. Could always assume that. It's a pretty safe assumption. Still nobody verified this. Are you still here, Hugh G? Guess not. Well, this sucks. uh, yeah, I don't know what to do, chat. I don't know what to do. When GameStop ended up closing out. Oh, it did well. Is the market still down? No. So, it would have been cooler if it was up while the market was down. Used car prices rise to the highest point since summer 23. Apple shares sink on report of foldable iPhone delays. Levi beats expectations on top bottom line, raises guidance. ICE agent shoots man in California after a weaponized vehicle. Chrysler CEO says there's a minivan resurgence, but stays quiet on product plans. Trump accounts put Robinhood in the front of the next generation of investors. Maybe. Bill Gates interview about Jeffrey Epstein by House oversight sets for June 10th. Trump administration finalized better than feared Medicare Advantage payment rate and boost to insurers. Universal Music stock rises after Perishing Square's $64 billion takeover proposal. Novo Nordisk's explosive Wegovy pill launch draws a new wave of patients into GLP-1 treatment. GLP-1s are hot. They're hot right now. Everyone's trying to get fit, I guess. Even I don't know much about those though. They're just like fat burning drugs as far as I'm aware, so I don't know. I don't know if you're necessarily getting healthier if you're losing weight by not. I mean, hopefully people are still like exercising and stuff, but if If you're not exercising, I don't know how you're losing weight. Do I think Microsoft can get dragged down by Gates' testimony? I can't possibly see an upside from it. I don't think that has anything to do with the stock, to be fair. Like, if you're thinking about the stock market as business and financial, you know, like what is Bill Gates going on an interview to talk about Jeffrey Epstein have to do with business or finance? Literally nothing, so I would say it probably doesn't matter. And Microsoft stock's down a ton already. So if Microsoft stock is going to continue to sell off, I wouldn't relate it to that. I would just relate it to it being a bearish stock at the current moment. But I couldn't put any weight on that for like a stock repricing or whatever, however you want to say it. I just don't think it matters much. I don't really relate news to stock price movement in general. So it's tough to say something like that would have an effect on the stock. Netflix's One Piece is coming back sooner, expected for season 3. Nothing there. Let's see. Bakery's horrifying prank backfires as customers won't stop trying to order AI cake. What? Employees at Michigan Bakery were stunned when the horrific cake they made for April Fool's Day became so popular that people actually wanted to buy it. Interesting. Dr. Pepper Freeze Pops? Angry Video Game Nerd celebrates 20 years on YouTube by releasing Lost 2006 video. That's kind of cool. I might watch that. Dirty Mountain Dew hits shelves nationwide with creamy twist on viral trend. Dirty Mountain Dew, huh? Chinese scientists bring Avatar to life with real glowing plants to replace streetlights. Really? That's actually pretty sick. Glowing plants to replace streetlights, huh? No video. It's pretty cool, though. I was hoping there'd be a video. Hero cat saves owner as PC starts burning from NVIDIA RTX 4090 meltdown. How does a cat save? I suddenly heard the cat keep screaming when I opened the door. I saw smoke and the smell of plastic. The cat's alert likely prevented a worse outcome. The incident highlights an issue that has followed NVIDIA's flagship GPUs since launch. RTX 4090 has been plagued by reports of its 16-pin power connectors overheating or melting under certain conditions. What a goat. That cat is a G. Saved his owner's life. Domino's launches Slice Sauce and offers access to $1,400 watches with orders. What? Limited luxury shopping unlock for pizza orders. Customers who order qualifying pizzas online can get the new sauce for free and unlock access to exclusive products. The Slice Sauce launch is also tied to a limited time access deal with Shinola for Domino's branded watches, wallets, and more. A Domino's watch? What? That's crazy. That's crazy. They're just hoping scalpers are gonna buy this shit. It seems like. That's weird. That's just such an odd, random thing. Very odd and very random. Plane delayed for an hour after bees swarm engine before takeoff. Ethan Klein and other YouTubers file a lawsuit against Apple over AI training practices. Kinton Ramen releases Mortal Kombat combo with fatality fries and chopstick collectibles. Okay. Not very interesting news. PlayStation wants to scan fan faces and put them in Gran Turismo 7 with more games planned. A PlayStation fan's about to become a video game character. Sony Interactive Entertainment launched the Player Base on April 7th, a community program built on a genuinely simple idea. Find a fan, scan their face, put them into the game. Huh. Kanye West blocked from entering UK by government ahead of wireless festival. Twitch competitor DLive closes down after 8 years. Chess grandmaster Hikura Nakamura spends over an hour on one move and still loses. Mr. Beast explains why it isn't feasible to do Beast games on YouTube. Mr. Beast spends millions just to store Beast game footage. Oh, he has a new interview? I'll have to check that out later. I'll have to check that out. Target warns shoppers are, quote, responsible if AI makes mistakes on orders. Viral Resident Evil statue clothes Leon in nothing but swimwear. What? That's so random, bro. It's so weird. So weird. Buffalo Wild Wings brings back $9.99 bottomless appetizer deal. YouTuber convinces stranger to rob a bank with him, but it's a simulation. Cruise ship stranded near the Tom Hanks Castaway Island. No videos, no photos. Okay. Okay. Oh yeah, I Show Speed's gonna have a match at WrestleMania. That's crazy. I think I Show Speed's about to become a WWE superstar potentially. McDonald's CEO says he's first made aware of the viral status when one of his children told him in a phone call, "Dad, you've gone viral, but not in a good way." That's when I knew something was going on. Started getting texts and emails and calls by the 1000th time. Yeah, I've seen it. Despite the numerous videos and posts poking fun of him, Kepsinzinken, I don't know how to say his name, ultimately believes it was good press moment for the Big Arch Burger. One of those things where it's great that people are talking about the Big Arch. I think when you go on social media in general, you have to be thick-skinned. Yep. Explaining it was a holdover from his childhood, saying his mother was quite strict about table manners. I'm definitely not a vegetarian. Blame it all on my mom. Don't talk with your mouth full. I think probably in that case, I should have just, what the hell with it? I'm going to talk with my mouth full. Huh. Not very exciting. You can now order Uber Eats and Grubhub through Alexa Plus conversation. Man admits to scamming elderly for $27 million in 2 years after being outed in YouTube video. Crazy. We live in a crazy world. Burger King to add 60,000 jobs after Whopper revamp causes sales to surge. Arnold Schwarzenegger's son wins 2 bodybuilding competitions in a week. What a boss. What a boss. Anything else? Baseball superfan goes viral as Dodgers won't let him use paper tickets for the first time in 50 years. Baja Blast shoes are selling out after Walmart's Mountain Dew collab. NVIDIA's DLSS 5 video removed from YouTube after TV station claims copyright on it. That's kind of funny. Pokemon superfans go viral after Master Ball used an engagement proposal. Ex-Nintendo sales lead warns Switch 2 price increase is inevitable. A lot of news, but nothing. New Steam feature estimates your FPS before buying a new game. Mr. Beast pits 50 streamers against each other with Final Four competing for 1 mil live. I watched that. It's actually pretty good. I mean, the live stream isn't that good, but as a streamer, I appreciate it. Fortnite players fear bye emote could be gone for good after Sony lawsuit. Fan scales SoFi Stadium roof for insane view of Kanye West concert. Is there a video? No, don't look like it. Oh, right here. What a boss. Who is this? Party Life? I don't know who that is. I thought it was going to be the Dying Llama or something like that. But no. That's so funny. That's so funny. Alright, anything else? There was a lot of news we just went through. Police carry out major sting operation to catch serial Pokemon card robbers. Pets in China now have their own dedicated streaming service. 90-year-old woman breaks world record for dead hang. Scientists create world first T-Rex leather handbag with 600K starting price. Good lord. The Sperm Racing World Cup. What? What the fuck, dude? What do we live in the most stupid world, bro. The Sperm fucking Racing World Cup, bro. Like, what? What even is that? What even is that, bro? You can win 100K if you got the fastest sperm, though. So if you think your sperm's fast, you better get in there, bro. You better get in there. Woman who threw tarantula at Airbnb guest found guilty of assault. Jeez. Washington, D.C. deploying rat birth control and 130K pest control plan. It's actually kind of interesting. Netflix's price rise ruled unlawful and customers want refunds. Delhi spends thousands to stop people from pooping on patio overnight. All right, that's enough. That's enough news. That's enough news for today. I'm good. I'm good on that. That's enough. What's going on here? That's enough of that. I don't know what's up with this earnings call. It's kind of whack. I don't know what's going on with that. How come I don't have like any options for sound or anything like that? Yeah, I don't know. Hopefully it starts working whenever they start the call. I mean, I guess it doesn't matter. Nobody's here for this. Well. All right. Where is this earnings call? Oh, there we go. It was just messed up. There we go. Got it. All right, this should be starting any minute now. appreciate the people that are in the stream. People who support the stream. Thank you guys. Hopefully we can keep going, but we'll see. We'll see. All right, where is this? But is it starting?
Good day, ladies and gentlemen.
You guys enjoy. I'll see you either after this or tomorrow. Appreciate everyone.
The period ending March the 1st, 2026. All parties will be in a listen-only mode until the question and answer session, at which time instructions will follow. This conference call is being recorded and may not be reproduced in whole or in part without written permission from the company. This conference call is being broadcast over the internet, and a replay of the webcast will be accessible for 1 quarter on the company's website, levistrauss.com. I would now like to turn the call over to Ida Orphan, Vice President of Investor Relations at Levi Strauss & Company.
Thank you for joining us on the call today to discuss the results for our first quarter of fiscal 2026. Joining me on today's call are Michelle Gass, our President and CEO, and Harmit Singh, our Chief Financial and Growth Officer. We'd like to remind you that we will be making forward-looking statements based on current expectations, and those statements are subject to certain risks and uncertainties that could cause actual results to differ materially. These risks and uncertainties are detailed in our reports filed with the SEC. We assume no obligation to update any of these forward-looking statements. Additionally, during this call, we will discuss certain non-GAAP financial measures, which are not intended to be a substitute for our GAAP results. Definitions of these measures and reconciliations to their most comparable GAAP measure are included in our earnings release available on the IR section of our website, investors.levistrauss.com. Please note that Michelle and Harmit will be referencing organic net revenues or constant currency numbers unless otherwise noted, and the information provided is based on continuing operations. Finally, this call is being webcast on our IR website, and a replay of this call will be available on the website shortly. Today's call is scheduled for 1 hour, so please limit yourself to one question at a time to allow others to have their questions addressed. And now I'd like to turn the call over to Michelle.
Thank you, and welcome everyone to today's call. I'm pleased to share that 2026 is off to a strong start. In Q1, we exceeded expectations across the top and bottom line, driven by every region and channel, underscoring the continued momentum of our strategies. As we've highlighted over the past few years, the strategic choices we have made to narrow our focus and maximize the potential of the Levi's brand are enabling us to pursue our highest return growth opportunities. We are becoming a more DTC-first denim lifestyle company, and it is leading to more consistent and faster growth, a much larger addressable market, and higher profitability. Today, we're operating from a stronger foundation, we're executing with intention, and we have more ways to win than ever before. Before I turn to our Q1 results, I want to briefly note a leadership update. Earlier today, we announced that after a planned transition, Harmit will retire following 13 years with Levi & Co. Harmit has been an exceptional partner and leader, playing a central role in strengthening our financial foundation as we've accelerated growth, expanded margins, and evolved into a more diversified, direct-to-consumer business. The discipline, systems, and high-caliber finance organization he built have positioned us well for long-term success. We've initiated a comprehensive search for our next CFO with the support of a leading executive search firm, and Harmit will continue to serve in his role until a successor is appointed. He will remain for a planned transition as an advisor to ensure continuity. Given the strength of our leadership team and the momentum in the business, we are confident in a seamless transition and remain firmly focused on executing our strategy and delivering sustainable, profitable growth. Let's now turn to the details of the quarter. As a reminder, all numbers Harmit and I will reference are on an organic basis. We generated another quarter of high single-digit organic net revenue growth, up 9% and up 14% on a reported basis. We delivered double-digit top-line growth in both Europe and Asia and 7% growth in the Americas. We drove 10% growth in the DTC channel with comp sales up 7%, reflecting strong underlying demand. Our wholesale channel exceeded expectations, delivering 8% growth, fueled by strength across segments. Growth in women's continued to accelerate, up 13%, in addition to 7% growth in men's. Our evolution into a head-to-toe lifestyle brand is fueling accelerated growth in tops, up 13%. And while we drove significant top-line growth, we also exceeded our adjusted EBIT margin expectations and delivered double-digit earnings growth in the quarter. This strong early performance gives us confidence to take up our full-year guidance. I'll now walk you through highlights from the quarter in the context of our strategies. Let's start with our first strategy, being brand-led. The Levi's brand was up 9% for the quarter as we continued to keep the brand firmly at the center of culture. Few brands can authentically play across so many facets of culture, sports, fashion, and music, in a way Levi's consistently does, and this was on full display during the Super Bowl. Leading up to the game, we turned the Bay Area into Levi's home turf with a full 360-degree activation, including exclusive product drops and live music, as well as hands-on workshops and in-store celebrity and athlete engagements. We also launched a number of exciting collaborations, including a new Nike apparel capsule and denim Nike Air Jordan 3s. We extended that energy during the game itself, launching our new global campaign, Behind Every Original, designed to unfold in chapters throughout the year. Premiering during one of the most watched moments of the Super Bowl, early results have been very encouraging, with strong awareness, brand equity lifts, and more than 1.4 billion media impressions generated in February alone. Featuring global brand ambassadors Doechii, Questlove, Blackpink's Rosie, and basketball superstar SGA, the campaign has been recognized among the top Super Bowl ads by outlets including Forbes, Ad Age, and Fast Company. Building on the strong momentum from our campaign, we announced a multi-year global partnership with Rosie, including new co-created pieces that will come to market later this year. And a prime example of Levi's showing up organically at the center of culture is Harry Styles wearing a pair of vintage 501s on his new album cover, and his backup dancers all wore 501s on stage at the Brit Awards in February. Now turning to product, where we continue to see strong growth in men's and women's and across tops and bottoms, fueled by innovation and execution. First, let's start with our bottoms business, which was up 7%. We're infusing newness across the assortment with innovative fabrics, fits, and finishes throughout both our icons and fashion styles. Within core bottoms, we continue to introduce modern interpretations of our iconic 501, like our very popular 501 90s and 501 Curve for her. And for him, the 501 Loose and 501 Thermodapt, our new climate-adapting fabric innovation. Another great example of the organic strength of our core is the 25% increase in our iconic 517s, which were famously worn by Carolyn Bessette and prominently featured in the popular show Love Story. Our newer fashion-forward fits across loose and baggy styles continue to deliver outsized performance. We're following the tremendously successful launch of last year's women's cinch baggy with an expanded assortment of cinch wide leg, barrel, shorts, and more. And for men, we introduced a new baggy barrel fit, which continues to drive fashion relevance for him. Our push into categories beyond denim bottoms has expanded our total addressable market and contributed to roughly a quarter of our top-line growth, with still much more opportunity ahead. Tops continue to be an important growth driver as we build out a more complete lifestyle offering. In men's, we saw continued success in polos, button-downs, and our newly launched quarter zips. And in women's tops, wovens, blouses, and sweaters were standouts, along with our expanded selection of tees. Dresses also continue to perform well as a natural extension of our lifestyle strategy. We've sharpened our product strategy by shifting toward a more globally directive assortment. In our DTC business, we've increased product commonality to nearly 50% today. This shift has driven greater productivity through SKU reduction and enabled us to focus on fewer, bigger product stories, showcasing our head-to-toe collections. As a result, we're showing up globally with more impact and consistency, and with clearer storytelling and stronger alignment across markets. A great example of this was the Q1 global launch of our head-to-toe grunge prep collection. This new aesthetic combines preppy tops like cable crew knit sweaters and rugby tees with worn-in grunge textured bottoms across fits like our 578 loose and baggy loose cargo pants. Blue Tab, which is the most premium expression of the Levi's brand, delivered robust growth in Q1, reinforcing our confidence in this business. We expanded the assortment, adding more women's product and lifestyle pieces while maintaining a solid foundation in premium denim. With just 1% market share of the $10 billion total premium denim market, this represents a sizable long-term opportunity for the Levi's brand. As we look to spring and summer, our global product assortment will continue to deliver against our big ideas with a unified lens. We will build on the momentum we're seeing today by expanding lightweight and linen blend product across tops, dresses, and bottoms, while also leaning into shorts, jorts, and other warm weather lifestyle pieces. Now shifting to our strategy to become a best-in-class DTC-first retailer. Our global direct-to-consumer business delivered double-digit growth, up 10% in Q1. Comparable sales were up 7% this quarter, on top of high single-digit growth last year. This marked our 16th consecutive quarter of positive comps as we continue to raise the bar on our retail execution. We've strengthened lifestyle merchandising and outfitting in stores, improved in-stock positions through better assortment planning, and invested in training our teams with a new global selling model. In the quarter, e-commerce delivered 17% growth, reflecting continued momentum as we elevate the online experience. Digital plays an important role in how consumers discover the brand and build a deeper connection with Levi's. Importantly, newer consumers engaging with us through e-commerce continue to skew younger. In Q1, 70% of new U.S. e-commerce orders came from Gen Z and millennials. This reflects our ability to connect with younger consumers as they enter the category, driven by product newness, lifestyle-led storytelling, and a more dynamic digital experience. Our loyalty program also continues to be a powerful driver of consumer engagement, reaching 46 million members globally, up 17% year over year, with more than 2 million new members added in the first quarter. Loyalty members spend about 40% more with higher transaction values and purchase frequency than non-members. Global wholesale continues to be an important part of our business to reach consumers around the world. Results this quarter were better than expected, up 8%, driven by strength across segments. The growth in wholesale reflects the momentum behind our lifestyle assortment, the strength of our partnerships, and our commitment to reaching Levi's fans wherever they choose to shop. Now turning to our third strategy, powering the portfolio. Our international markets continue to demonstrate strong momentum, up 12%. Europe grew 10% in Q1, with growth across most major markets. Having recently visited stores across Europe, I got to see firsthand how strongly consumers are responding to our elevated denim lifestyle assortment. One of the markets I visited was Italy, which plays a unique role as a premium halo for Levi's across Europe, shaping brand perception well beyond its borders. As a global center of fashion and culture, we have elevated our presence in the market, and revenues in Italy have nearly doubled since 2021. Importantly, we have continued to strengthen our number one share in denim bottoms across both men's and women's in this market. In Q1, our value brand Signature grew 16%, reflecting impressive performance in women's. Over the past year, we have revitalized Signature through a product and brand reset, introducing compelling newness and expanding into lifestyle categories. This is translating into share gains for the brand within key wholesale accounts, a clear signal that the revitalization is resonating with consumers. Beyond Yoga was up 23%, with DTC continuing to show solid momentum. The brand expands our addressable market into premium activewear, complementing our denim lifestyle portfolio. Our recently launched Seek Beyond marketing campaign and broader product offerings are gaining traction with consumers and fueling growth. While we continue to invest in the business, our operating loss narrowed in the quarter, driven by strong top-line growth and gross margin expansion, reinforcing our path toward profitability. In closing, the quarter reinforces the significant progress we're making against our strategies. We're seeing the impact of becoming a more brand-led, consumer-centric, DTC-first lifestyle company with broad-based strength across our business. The work we've done to sharpen our focus, elevate the Levi's brand, and operate with greater discipline is translating into higher quality, more profitable growth while building a stronger foundation for the business. While we remain thoughtful about the external environment, we're confident in the direction we're headed as we move through the year and beyond. With that, I'll turn it over to Harmit to walk through the financials and our outlook. Harmit.
Thank you, Michelle. I wanted to take a moment to speak about the announcement we made earlier today. After 13 years with the company, I will retire following a planned transition. This company and our people have meant the world to me, and it's been a true privilege to work alongside Michelle, our board, and all our shareholders and the extraordinary leadership team as we have transformed this company into a more diversified global direct-to-consumer business. I'm incredibly proud of what we've built together, from accelerating our growth, transforming the company into a DTC-first retailer while expanding margins and returns. What gives me the greatest confidence as I look ahead is the strength of my team and the deep talent we put in place. I'm so grateful for the support of me and the company. I'll remain fully engaged as CFO and Chief Growth Officer until a successor is appointed and stay for a planned transition. Ellis & Co. is stronger than ever, and I have every confidence in the company's continued momentum and ability to deliver long-term profitable growth. Let's turn to quarter one. We delivered another strong quarter, marked by high-quality, broad-based growth and stronger than expected profitability. Our first quarter results reflect the power of the and. While our top-line outperformance this quarter was driven primarily by better than expected wholesale performance, DTC remained healthy. More broadly, every facet of our business has contributed to growth over the past 6 quarters. Wholesale and DTC, US and international, women's and men's, tops and bottoms, units and AUR. Our focus on improving flow-through, that is converting a higher percentage of revenue into profit, enabled us to exceed our adjusted EBIT margin expectations and deliver higher earnings. As planned, we leaned into A&P earlier in the year to support the launch of our 26 global campaign. Normalizing for this timing, adjusted EBIT margin of 12.5% would improve 160 basis points to 14.1%. While we continue to take a prudent approach to planning for the balance of the year, our strong first quarter results and positive quarter-to-date trends position us to raise our expectations for revenue, margins, both gross and adjusted EBIT margin, as well as adjusted diluted EPS. Turning to the details of the quarter, net revenues were up 9% with broad-based trend across all segments and channels. Our international business contributed to about 75% of our growth. Women's accounted for approximately 55% of total growth. DTC accounted for just over half the growth. By category, tops drove roughly a third of our growth in this quarter, and growth was driven equally by higher volumes and higher AUR. Given the ramp-up of our distribution center in Europe last year, shipments moved from quarter one to quarter two. As a result, Quarter 1 26 revenue growth benefited by approximately $30 million or about 2 percentage points. This will have an offsetting impact in Quarter 2. Excluding this timing shift, Quarter 1 still delivered high single-digit growth. I'll address the impact on Quarter 2 in our guidance. Gross margin for Quarter 1 was 61.9%, slightly better than external expectations, contracting 20 basis points year-over-year, primarily due to tariffs. The decline in gross margin was partially offset by pricing actions and lower promotional activity. We continue to closely monitor the consumer response to pricing actions, and to date, we have not seen an impact on demand. From an input cost perspective, we have locked in ocean freight rates and secured cotton at favorable levels for 2026. Adjusted SG&A grew 16%, driven by higher A&P, the higher-than-expected sales volume, and foreign exchange. Excluding the 160 basis points impact of A&P, we delivered 90 basis points of leverage across the balance of the business. We still expect marketing as a percentage of sales to be approximately flat year-over-year at around 7%. Improving flow-through remains a key priority, and we're taking deliberate actions to deliver it. Across the organization, we're leveraging our global talent hubs and accelerating productivity through expanded AI initiatives, allowing us to support a growing business while keeping overall headcount flat year-over-year. At our recent leadership summit, we aligned our top 250 leaders around tighter SG&A discipline and a sharper focus on converting top-line growth into consistent profitability. And importantly, our leadership team's incentives are directly aligned with driving both revenue growth and profitability. With respect to the status of the U.S. distribution network transformation, execution continues to progress, and notably, distribution expenses versus prior year improved as a percentage of revenue. We are working towards completing the transition by mid-year, and costs we expect to incur are factored into our updated guide. Longer term, this transition positions our network to support omnichannel growth and drive efficiency. Adjusted EBIT margin was 12.5% in the quarter. Excluding the A&P investment, adjusted EBIT margin would have been 14.1%, substantially higher than last year, and reflecting flow-through of approximately 40% from the higher revenue. Adjusted diluted EPS was 42 cents, ahead of our expectation and up 11%. We ended the quarter with reported inventory dollars up 4%. We're comfortable with the quantity and quality of our inventory as we enter the spring season. Turning to shareholder returns, we took another important step forward this quarter with the successful closing of the Dockers transaction, which further simplifies our portfolio and sharpens our focus on the Levi's brand and Beyond Yoga. Our adjusted free cash flow in Quarter 1 26 was also substantially higher than last year at $152 million. This, along with the net proceeds from Dockers' sale, enabled us to return cash to shareholders through shares repurchases. In total for the quarter, shareholder returns were up 163% to $214 million. In Quarter 2, we declared a dividend of 14 cents per share, an increase of 8% year-over-year. Now let's review the key highlights by segment. The Americas net revenues were up 7%, driven by 4% growth in the U.S. and 14% growth in LATAM. This was fueled by strength across DTC and wholesale channels. U.S. wholesale was up this quarter, even with our actions to rationalize certain customers. The acceleration in LATAM was driven by double-digit growth across every market, including Mexico. Operating margin contracted 260 basis points due to the timing of A&P and the impact of tariffs. Europe grew 10%, with solid demand and strength across markets and channels as consumers continue to gravitate towards our head-to-toe offerings. Operating margin expanded 50 basis points, driven by gross margin expansion. Given the distribution transition we are lapping in Q1 and Q2 of 25, it is best to look at Europe on a H1 basis. We expect Europe to grow mid-single digit in the first half of the year, consistent with our guidance for the segment. And importantly, pre-book for the fall and winter season is up high single digits. Asia grew 12%, fueled by growth across both channels, led by DTC, which was up 16%. Key markets like India, Japan, Korea, and Turkey delivered strong results across channels and categories. China was also positive, reflecting early progress and green shoots under new leadership as actions to reset the business begin to take hold. Gross margin expansion and SG&A leverage drove 150 basis points of operating margin expansion. The Middle East, which is part of our Asia segment, represents about half a point of total company revenues and is mostly operated as a distributor model. Now turning to guidance, 26 is off to a strong start, and as a result, we're raising our outlook across revenue, margin, and earnings while maintaining a prudent view on the macro environment. As a reminder, our guidance assumes incremental U.S. tariffs on imports from China at a 30% rate and the rest of the world at 20%, and therefore does not contemplate the recently announced Supreme Court ruling or the administration's effort to reimpose the tariffs. While this has not been incorporated into our guidance, if the 10% tariffs currently being charged stay in place for the rest of this fiscal year, we believe there could be an incremental benefit to our current outlook of approximately $35 million to COGS and 7 cents to EPS. For the full year, we are raising our expectations for both reported and organic net revenue growth by 0.5 point. We reported growth to be up 5.5% to 6.5%, and organic revenue to be up 4.5% to 5.5% for the full year. The increase in our top-line expectation is due to stronger than expected performance in the U.S. wholesale channel, and we now expect global wholesale to be up low single digits. Gross margin is now expected to be flat to slightly up versus our prior expectation of flat to prior year. Adjusted EBIT margin is now expected to be approximately 12%, up from our previous expectation of 11.8% to 12%. And we now expect adjusted diluted EPS of approximately $1.42 to $1.48, up from $1.40 to $1.46. For quarter two, we expect reported revenues to be up 4% to 5% for the quarter and organic up 3% to 4%. As I previously mentioned, growth in quarter two would have been higher by approximately 2 points due to the timing of last year's distribution transition, which reinforces that there is no change in underlying demand trends between quarter one and quarter two. Gross margin is expected to be slightly down due to unfavorable foreign exchange. We expect to fully offset the impact of tariffs through our various mitigation efforts. Adjusted EBIT margin is expected to be in the range of 8% to 9%. This translates to an adjusted diluted EPS of approximately 22 to 24 cents. Let me provide some color on the margin cadence of our full year outlook. Given our Q1 results and Q2 guidance, we expect H1 EBIT margins to be in the range of 10 to 11%, and we expect accelerated margin expansion in the second half year, driven primarily by 4 factors. First, the normalization of A&P, effectively pulling a point of A&P out of H2 into H1 behind the launch of a campaign, which was primarily expensed in H1. 2, given the seasonality of a business, which is weighted more towards the second half, the incremental volume drives higher fixed cost leverage. 3, we will begin to realize the full benefits of our pricing actions, which had not yet been implemented in H2 of last year. Fourth, lower distribution expenses as we ramp down the parallel distribution center. This positions us for in H2 EBIT margins to be in the 13 to 14% range, consistent with our full year guide of approximately 12%. In summary, we delivered our sixth consecutive quarter of mid to high single-digit growth, driven by both our wholesale and DTC channels. DTC now represents about half our business and continues to be a significant growth driver. We reported 16 consecutive quarters of comp sales growth, and as you saw in this quarter's press release, we reported comp growth of 7%. We will continue to report comp sales as part of our regular disclosures. We raised guidance, reflecting our momentum and execution against our strategies while maintaining a disciplined, balanced approach to the full year. Michelle, I, and the entire executive team are committed to flowing a higher percentage of revenue to profitability, solidifying a clear path towards a 15% EBIT margin over time. And with that, I will now open up the line for Q&A.
Thank you. The floor is now open for questions. If you have a question, please press star, then the numbers 1 on your telephone keypad. Due to time constraints, the company requests that you ask only one question. If you have any additional questions, please queue up again. If at any point your question has been answered, you may remove yourself from the queue by pressing star 11 again. Our first question comes from the line of Laurent Vasilescu of BNP Paribas. Your line is open, Laurent.
Oh, good afternoon. Michelle, Harmeet, congrats on a great start to the year. And Harmeet, I want to quickly say it's been a real pleasure working with you over the last few years. So Michelle, can you talk about what's driving the momentum in the business and how confident you are in sustaining that momentum, particularly with the uncertain macro backdrop in Europe and North America, which I think everyone is really laser focused on. And then Harmeet, on SG&A, thank you for unpacking a little bit on the SG&A growth of up 16%. I saw in your 10-Q tonight, distribution expenses actually went down for the first time. How should we think about these distribution expenses and overall expenses for the balance of the year to get to that 1H, 2H operating margin that you laid out?
Great. Thanks, Laurent, and thanks for the question. So I'll kick it off and I'll hand it over to Harmeet. So first off, we're really pleased to start the year so strong with, of course, a beat on the top and bottom line. But the 9% organic growth, 14%, it was high quality and directly linked to the execution of our strategies. We saw the growth broad-based across segments, channels, genders, and categories. And just to share, like if we take one of our key strategies, which is this pivot to denim lifestyle, we saw outperformance in the women's business up 13%. We saw outperformance in tops up 13%, which really demonstrates that we can grow our addressable market. And while we did this, called the core of our business of men's and bottoms, both still really strong at plus 7%. So, strategy number one. Second strategy on this, we are becoming a best-in-class DTC retailer. DTC is continuing to fuel the growth. It was up 10%, 7% comp growth. We're very pleased to start sharing that number. And our wholesale business grew as well at up 8%. So again, this is about execution. And as we look ahead, we see a lot of runway ahead to the second part of your question in terms of sustaining the momentum. It's the cause and effect on executing our strategies, and the consumer is responding. We are very cognizant of the environment around us, but our consumer is responding to innovation, newness, and Levi's is a great value. So we'll stay close. But given what we're seeing in the business and how we started this quarter, we feel very confident, and hence why we were confident enough to raise our guidance for the year.
And Laurent, to your second question, first, appreciate your remarks. I still have a job to do. We still have to deliver the year, so I'm around for a while. But to your question on SG&A, in essence, SG&A as a percentage of revenue was a little over 49%. We expect to deliver the year with SG&A as a percentage of revenue, around mid to high 49%, lower than a year ago. This just unpacking this quarter. Let's start with SG&A was up 16%. A&P was the timing of A&P, because we are assuming that we spend only 7% of revenue by the end of the year, was approximately 5% of that 16% increase. Foreign exchange, it's interesting because of our global business. When the US dollar is weaker, which we have seen over the last couple of months, when you convert that into dollars, it impacts SG, and that's about 4 to 5 points. And the remaining 7 points was largely driven by volume, were driven by a little bit of inflation and what we call, as we expand DTC, we continue to open doors. So overall, SG&A, we believe will continue to improve as a percentage of revenue. The other thing that because we've taken this to heart, which is we have to convert a higher percentage of revenue into profitability. And I shared with all of you, what we are doing as a team, bringing the 250 leaders together, talking about why flow-through is important, and how that acceleration of growth along with profitability really enhances and creates a lot of value for all our stakeholders.
Thank you very much.
Thanks, Laurent.
Thank you. Our next question comes from the line of Oliver Chen of TD Cowen. Your line is open, Oliver.
Thanks so much. Harmit, congrats on a really wonderful career. Regarding the guidance, it seems conservative given the 2-year stacks decelerate, and you've been posting better and solid numbers. Why wasn't the guidance higher in terms of all the momentum you're seeing? And in the U.S. wholesale, which parts of that business were better than expected, and do you expect that momentum to continue? And as we look forward on the... Go ahead. Thank you.
Go ahead. No, Oliver, go ahead.
Oh, as we look forward on the margin side, what should we know about mix as you continue to make so much lifestyle progress, and/or what's embedded for promotions? Because it's not an easy environment out there, but you're experiencing a lot of innovation, and gas is on everyone's mind on a near-term basis as well. Thank you.
Sure. Oliver, two things. It's early in the year. We have a sizable beat, and while we haven't seen, even in quarter-to-date trends, any real change in trends, our view is that, be prudent in the outlook as we think forward. So that's really, what's driving what we call a more prudent outlook. The only other thing to think about is we haven't incorporated the reduction in tariffs, which may come to pass at some stage, right? We've quantified it, but we haven't incorporated that. That gives us what I call contingency or cushion, should the environment, change in any dramatic way. And so that's how we are thinking about it. The real focus of the company, as Michelle pointed out, is to continue the momentum on the top line while converting a higher piece of that, revenue into profitability. We have taken gross margins up for the year, from what we said, flat to slightly up, because we think we can fully offset, the 19% increase in tariffs. We have taken EBIT margins up to the high end of the range, and we've taken EPS. So, we feel generally positive from that perspective. In terms of your mix, so your question about wholesale, what really drove, the beat on wholesale, and it is true that 2/3 of the beat was largely driven by wholesale, and it was largely the U.S. and Europe. And the outperformance was really, we're beginning to see, what is showing up in DTC by driving denim lifestyle now get incorporated by our partners buying more women's. Women's, growth in wholesale was really strong. They're buying more tops. That's making a difference. And, the good news is there's still a balance between units and ARs, even in wholesale. So I think that's been the, I would say the thought, which is start with DTC, prove it out, and then, showcase that so that your partners buy. And I think we're beginning to see it. And it's still fairly underpenetrated. Women's in wholesale is underpenetrated. Tops in wholesale is underpenetrated. And so I think those are the factors that really, I think from our perspective, we believe there's a long runway for growth, a $6.5 billion company getting to $10 billion over time.
Thank you. And Michelle, one for you. Just what's ahead on your thoughts on denim momentum? Because one question is if we're at a peak place in the denim cycle, but you're doing a lot and things are changing with baggy and head to toe. And as you embrace loyalty, the loyalty program and AI and personalization, how might you see that manifesting and what's happening with innovation? Thank you. Best regards.
You bet. I'll hit those quickly. The denim category remains healthy. It's actually accelerating here in the U.S. It's outperforming overall apparel. Clearly, as the leader in the category, we are fueling that growth through all the innovation and fashion cycles we're bringing. So we sit here today, again, we've contemplated that in our guide that we expect the momentum through our strategies to continue. And loyalty, AI, our e-commerce business, again, up double digit, and we are now leveraging AI tools to help that consumer engagement. Loyalty, again, as we shared in our remarks, is up, again, acquired 2 million consumers in the quarter. Thanks, Oliver.
Thank you. Our next question comes from the line of Ike Boruchow of Wells Fargo. Your question, please, Ike.
Hey, thanks. Congrats, everyone. Harmeet, we'll miss you. But a question for you, actually 2 questions for you, Harmeet. Can you just clarify the commentary on Europe in the second quarter? So you're basically guiding Europe organic constant currency revenue flat in the second quarter. Can you just quantify the wholesale, the dollars that moved into 1Q that are moving out of 2Q, just so we can smooth that out? And then to Laurent's question on the DC side, what's your expectation for the remainder of the year? You're already getting scale on that line item, and it feels like a lot of the initiatives haven't really kicked in yet that should drive leverage. Just what's the expectation for leverage on that line item the rest of the year? And then how quickly could you potentially get that line item back to 5% of sales? Is that 4 to 5 years, or is that more like 2 to 3 years?
Okay, so to answer your first question, which is Europe, I quantified it. It's about $30 million, and it's primarily wholesale. And so, you can do the math, but that's really and you're right, Europe up 10%, primarily flat in quarter 2, but for the first half, about 5, mid-single digit. We're guiding Europe to be mid-single digit. The other pleasing fact in Europe is that our pre-book for fall and winter is looking at approximately high single digits. So, we're feeling good about the Europe business. The team in Europe is executing really well, and so that's really what's driving. That's the amount, and that's what's driving the shift. To your question about the transition of the DC, I mean, just think of this broadly. I would say Europe transition that began about a year and a half ago has stabilized. You're seeing it in their results. We're doing more omni-channel fulfillment, and that's making a difference. It took us a little while, but distribution costs in Europe now are scaling down as a percentage, really well. U.S., we continue to be committed to reducing the transition costs as the year progresses, and we'll do it in a way where we prioritize the incremental demand that we are seeing with the costs incurred, because we have seen volumes, really pick up, and fulfilling that has been great. As I mentioned earlier, we continue to expect the cost of additional DC to taper off as the year progresses, beginning in the second half. And, our DC that is being run by Merce really stabilized. So to your question about when do we get to 5%, distribution cost as a percentage, I won't comment on the timing, but what I will say is our new supply chain leader and the new distribution experts that we've got are committed to improve both the flow through, so we drive higher volume throughput, as well as lower costs, over time. And it's built in to our plan. It's to get from 12% to 15%. So, we are committed as an organization. It's a big piece of, what we're focused on. So stay tuned.
Thanks, Harmeet.
Thanks, Ike.
Thank you. Our next question comes from the line of Jay Sole of UBS. Please go ahead, Jay.
Great. Thank you so much. Maybe, Michelle, can you just talk a little bit more about what you're seeing in the U.S.? And I think you mentioned quarter date was good. We've been through Easter, how it's been. And then also, it sounded like the Super Bowl was a big event for Levi's, but I think Levi's Stadium is hosting 6 games for the World Cup this quarter. Are there plans around that? Will that impact SG&A? And how should we think about that opportunity? Thank you.
Yeah, you bet. Thanks, Jay. So first, I'll take your question on the U.S. Pleased with the start of the year in the U.S. as well. We were up 4% in the quarter, and we saw both channels performing well this quarter, especially reflecting the strong execution that we're seeing both in our DTC channel, strength in stores and online, driven by enhanced merchandising we're doing, expanded lifestyle assortments, and I'll get to the marketing campaign in just a minute, but clearly it was a very unique way to start the year. We're very pleased with that. And U.S. wholesale was up this quarter. Again, very strong performance with our customers. And to make note, not only in Levi's Red Tab, but in our signature brand, our value brand, that was up 16% in the quarter. So, one of the things that we've really moved to with the whole opportunity to amplify the power of the Levi's brand is to segment. So you've got your core Red Tab, which is the core of our business. You have signature, which is accelerating. They're bringing a lot of newness and relevance to that consumer, to that value-conscious consumer. And then, of course, on the high end, early stages with Blue Tab, but we're seeing nice consumer reception. And that new business was up 40% in the quarter. So we're obviously staying close to the dynamics in the macro environment, but in terms of our consumer, we're seeing a lot of resilience there. And then to your point on the Super Bowl, I mean, we couldn't be more pleased with how our launch of our new brand campaign resulted. So we had a very unique opportunity with Levi Stadium hosting the Super Bowl. So we were on the world stage, center of culture. We leaned in. We launched our new campaign. It was the first time in 20 years. It got watched in the peak of the watch of the Super Bowl, 1.4 billion impressions. We have measured that. We got a great return on it. And really, this is about the launch for the year. So it's a formula that works for us, tapping into global and local influencers. And we will continue to activate against sports and music. So to your point on World Cup, we do have plans for that throughout the year, as well as music collaborations. And all of that is baked into our plan, which takes us to a 7% for the year in terms of spend. So, call it the peak of our spend was actually in the first quarter. That normalizes as we go through the balance of the year. We're seeing the results. We're getting a nice tailwind from all the brand activations.
Got it. Thank you so much.
Thanks.
Thank you. Our next question comes from the line of Brooke Roach of Goldman Sachs. Your line is open, Brooke.
Good afternoon, and thank you for taking my question. Harmeet, best of luck in your next chapter. It's been great working with you. I was hoping that you could unpack how you're thinking about pricing and the pricing power of the brand as you look forward into the rest of the year. Did you see any elasticity in response to some of the recent price increases? And does this give you confidence to take even more pricing in what looks to be an even more inflationary environment? Potentially offsetting that, what are your plans that are embedded in the guide for markdowns in the back half of the year? And how should we be thinking about opportunity for continued markdown reduction as you implement your initiatives? Thank you.
Brooke, I'll take that question. Around pricing, and I'm glad you asked it because when we think about pricing holistically, it is about the premiumization strategy that we have on the brand. Mitigating tariffs has just been one component of it, but it is about our focus on full price selling, on less promotions, and pricing for innovation and newness. And I was just talking about, even at the kind of pinnacle expression of the brand with Blue Tab, we're pricing in the $200-$300 range. So very consistent with what we've shared in the past. We've been very thoughtful and targeted. We are monitoring consumer response, and to date, we have not seen an impact in demand, and you saw that in our Q1 results. And as a matter of fact, growth for us in the quarter was driven equally between AUR and units, which really does speak to the power of the brand right now. But we'll continue to be very thoughtful. We're clearly operating in an uncertain and volatile time. But given the strength of the brand, we feel really good. And our consumer is responding, especially as we take those opportunities to premium price for innovation and newness.
Great, thanks so much.
I guess the second part of your question would be around markdowns. The only thing I would say to that is, as we rewire the company to truly operate as a best-in-class retailer, we have new allocation systems, we have new supply chain leadership, and our execution level is improving, which you see that again in our AURs, more full price selling. So the capability of the team is really elevated around that front. Okay.
Thank you. Our next question comes from the line of Bob Drbul of BTIG. Your line is open, Bob.
Hi, good afternoon. I guess, Harmit, I have a question for you. First of all, congratulations again, and I echo a lot of the earlier comments and sentiment. I guess you talked about ocean freight and cotton being locked through 26. Can you talk about just, have there been, sort of discussions around trying to, for your vendors trying to pass through any, increases away from your current locked rates? And I guess the other question is just on that is, how far are you locked with, ocean freight and cotton, through 26? Thanks.
Thanks, Bob, and you were great on CNBC earlier. What I'd say is, and thanks for your sentiment, what I'd say is that we are locked through the end of the year on base ocean and air freight rates. There are surcharges that are imposed. Our view on the surcharges is that our guidance reflects this. Oliver talked about, why are you being modest in your guidance? We are taking into account a bunch of things, relative to that. Your question about vendors, asking for higher prices. When we reduced the product costs in 2026, it was a combination of a couple of things. First was rationalizing the SKUs, moving out of unproductive SKUs. It was about driving higher globally directive assortments, which is, having more of a common line, which drives more leverage through volumes. And, cotton, obviously lower than a year ago, really helped. And so we're very thoughtful because we've got vendors who've been with us for years, and we introduced some newer competition. So, right now we are not seeing it. If you think of the futures of cotton as you look at 27, they're largely consistent with what we believe. And our view is that product costs over time, because we are not rationalized all our SKUs. We haven't rationalized all our fabrics yet. We're driving to more of a tighter, go-to-market calendar. It was 16 months, it's close to 13. We're trying to drive that. So I think all those are different levers that we have that over time can, continue to drive product costs in the right direction, which is lower, not a higher.
Great. Thank you very much. Good luck.
Thanks, Bob.
Thank you. Our next question comes from the line of Rick Patel of Raymond James. Your line is open, Rick.
Hi, this is Suraj Malhotra on for Rick Patel. Thank you for taking our question. And Harmit, thanks for everything and best of luck. So looking at the 4.5 to 5.5% organic revenue growth guidance for fiscal year 26, how should we think about the split between unit growth and AUR growth, especially given the pricing actions taken year to date?
Yeah. Thanks for expressing that sentiment. Same here. You guys have been great. The way we are thinking about it is an even balance between units and AURs. The reason, the question is why we're selling more. It's largely because we are expanding our addressable market. Addressable market, which is $100 billion for denim. And you've heard me say before, we're trying to bust the myth that we're not only about denim. Now that addressable market is up 15 times, because we're getting into things like non-denim bottoms, skirts, and dresses for her, expanding our tops offer. So that's why we feel selling more, and we are adding a lot of new stores. So selling more along with higher AUR is probably, what's going to happen through the year. Where does that balance go over time? I think is something that we will, reinforce as we guide annually. But that's how we're thinking about it, and that's what I would suggest. As you model both that.
All right, Latif, we can go to the next question.
Thank you. Our next question comes from the line of Paul Lejuez of Citi. Your line is open, Paul.
Hey, thanks, guys, and Harmit, best of luck. It's been a pleasure working with you. If we go back to the first quarter, I'm just curious how things looked on a monthly basis. How much of the quarter was driven by December results versus the months that followed? And maybe if you can tie that into what you said about quarter to date. I think you said you haven't seen any signs of a change. Curious if you could talk about that by region, if there are any places that you might have seen an acceleration or deceleration relative to either the first quarter as a whole or the exit rate.
Yeah. Thanks, Paul. As you know, we don't get into the level of details. I'd say on the quarter to date trends, they remain positive and support the guidance that we laid out for you. In terms of trends in quarter one, I think we ended the quarter at 9%. January, February, largely in line with that. So it was not like it was way off or either higher or lower. Do remember that the trends acceleration in the quarter, as you think about timing, we had the Chinese New Year timing and then the Dorsten timing in Europe. That does impact it. So January, February, probably a little higher than December because of that. Chinese New Year is largely towards the end of the quarter. Dorsten was largely a January, February piece. But, our guidance for quarter two really reflects, how we've started the quarter.
Got it. And then any change to your macro view by region?
Asia started really strong, Paul. Asia really started strong, which is great. China, we didn't talk about China. I think I mentioned it, was positive for the first time in a long time. We've got a new team there. They're resetting the business. So our view is, and Asia, we underpenetrated, right? It represents about 20% of the business when half the world's population is there. And you've seen the operating margin in Asia, we take the last 3-4 years, improve as we drive more volume leverage. Outside that, Europe and US largely consistent, and so nothing apparent right now. I think the consumer continues to be resilient. Importantly, they continue to gravitate to newness, and our product pipeline is really strong, and Michelle referenced in her prepared remarks. And so I think if there's a way we can continue to bring newness in, which we believe we can, and drive that at good value price points, I think we can continue the momentum, and that's what's reflected in our full year guidance.
Got it. Thank you. Best of luck.
Thank you. Our next question comes from the line of Adrienne Yih of Barclays. Your line is open, Adrienne.
Great. Thank you very much. Let me add my congratulations on the quarter and also your future, Harmit. And my question is, it remains on international and the strength that you're seeing there. I guess, where are you seeing kind of the most surprise in terms of growth acceleration, and how does your go-to-market strategy differ by region, say like wholesale versus DTC? Thanks so much.
Yeah, so I'll just give you a quick perspective across the three regions. If you take the Americas and US in particular, it was primarily wholesale, but now this balance is shifting to to more of a balanced business between DTC and wholesale. And it's not coming at the cost of wholesale. It's that DTC is growing at a much stronger pace, and we're now opening. We have about 70, 80 full price stores in the US. We're probably going to be opening 10, 12 stores a year for the next couple of years and doubling that. Asia is 60% direct to consumer and 40% wholesale, and that is primarily how we think the business grows. Most of our new stores are actually opening in Asia. And Europe is a little higher on DTC than wholesale, but the product is largely a tier 1, tier 2 product, so very harmonious between the two channels. I haven't spoken about Latin America, which is another big opportunity for us to grow. I mean, they've been growing double digit for a while, and the team there is doing a great job. So as we think about different regions, that's the mix. I mean, our view is Asia, you grow that in the high single digits. That's what's reflected in our guidance. Europe in the mid single digit, that's reflected in the guidance. And America's low to mid single digit, that's reflected in the guidance.
Great. Thank you very much. Best of luck.
Thank you.
Thank you. At this time, I'd like to turn the floor back over to the company for any closing remarks.
I want to say thanks, everyone, for joining the call, and we look forward to speaking with you again at the end of Q2 in July. Thank you.
Thank you. This concludes today's conference call. Please disconnect your lines at this time.
Oh, thank you. That was, I honestly didn't listen to most of it. I went upstairs and made food, but there's nobody here, so if you're still here and you're an OG, I appreciate you. It says there's like 3 people here. Oh, what's up, Rosh? Good to see you, Rosh. I'm out of here, though. Unless you got, Rosh, did you verify that thing? Were you able to verify whether that, whatever it is, Roaring Kitty's brother bought shares or something like that? Saw something about that. Yeah, this. Social media erupted after Roaring Kitty's brother hinted at purchasing GameStop or AMC, reigniting speculation among longtime holders. Participants view this as a potential catalyst for renewed momentum in the MemeStop saga. So I wasn't able to someone in the chat said there was a tweet about it, but I haven't seen anyone else verify. So I'm just not sure if that's a real thing or not. He posted that. He'll remind Kitty to come back. Yeah, that's what Grady said as well. I just haven't seen anyone like share the post or anything, so I wasn't sure if it was actually a thing or not. He just focused on family, apparently. Well, that's good. That's a good thing to focus on. That's a good thing to focus on. But hope you're doing good, Rosh. Hope you're doing good, bro. I'm gonna get out of here. I've already been streaming for over 4 hours, but you know it's funny. The SEC gave $50 million to a whistleblower. Wait, for what? And today we had a $50 million order on GME. A whistleblower for what? And how do you have the volume was only 6 million, so how do you have a 50 million order? I don't know if that's I never heard about that. SEC 50 million whistleblower. look at the volume in dark pools. Oh, I don't trust dark pools. I don't know if that's real or not. I don't trust dark pools. Oh, this? SEC awards whistleblower over 50 million for enforcement tip. Is that what this is? I can't read it. It's a Bloomberg article. Don't know if that's something. I don't know either. I just don't trust dark pool stuff. I see that on Reddit and stuff all the time. Well, more on Twitter when I had it a lot. But I just can't put any weight on dark pool stuff. I just don't think it's real. Maybe it is, it probably is, but I just can't personally put any weight on it or anything like that. See, SEC announced an award of more than 50 million to pair of joint whistleblowers. Oh, that's 2021. Let me try Google. I lost my job again, so now I can join more often. Wait, didn't you just get that job? What happened? I thought you just got that job. For some reason, it's not popping up on, I don't know why it's not popping up. The only thing I can find is this Bloomberg article, but I can't read it. They apparently miscalculated their budget. That sucks. That sucks, man. I'm sorry. Hopefully you can find something better. Yeah, I just can't read it. Here, I'll just type in SEC awards whistleblower over 50 million for enforcement tip. Yeah, there's nothing on it besides that Bloomberg article. Let's see. Here's the AI thing. SEC awarded over 50 million to a whistleblower for providing significant information that led to an enforcement action. This is part of the SEC's whistleblower program, which was established to encourage individuals to report potential violations of federal securities laws. The SEC's whistleblower program offers monetary awards to eligible individuals who report original, timely, and credible information that results in enforcement actions with over $1 million in sanctions. The SEC has awarded more than 60 million to 48 individual whistleblowers in fiscal 25, a significant increase from the previous year. Program's awards range from 10% to 30% of money collected when sanctions exceed $1 million. Yeah, I don't know if that has anything to do with GameStop straight up. Maybe, but I don't know if it does or not. It doesn't really seem like it. Yeah, it would be kind of interesting if it is legit. I just can't believe anything on the internet, especially when it comes from like Twitter or Reddit or and a lot of the dark pool stuff comes from Twitter and Reddit, so I just can't, man. If it's not something I can like personally verify or anything like that, it's just nothing to me. Yumi's flat for line for so long, I get bored. That's fair. That's fair. I just like I like real information that's like verifiable, It's like dark pools GameStop. I mean, maybe there's a website for this or something. GME Dark Pool Stats. See, I mean, even the volume on this is only 8 million, so see, I just can't trust anything, bro. You just can't trust anything. You just can't trust anything if it's coming from like Twitter or Reddit. It's unfortunate, but just a lot of fake information out there, especially when it comes to the stock market. It's not even just GameStop. There's just a lot of bullshit information in general. It's just how it goes, man. It's just how it goes. You gotta dig for the truth. But I'm out of here, bro. Hopefully I'll see you tomorrow. I'll be on for APLD earnings or whatever. So appreciate you stopping in, bro. And I hope you have a good rest of your night, my friend. And whoever else is here, appreciate you. Y'all have a good one. I'll catch you tomorrow. God bless. Peace. Later, bro.